kind of stuff?
It's an achievement.
All right.
You know? I think it's awesome.
Good stuff. All right, we're going to have more coming up. This is Bloomberg. Good morning. Let's get some company news right now with Lisa Mateo.
Good morning. Target posted better than expected second quarter profits, overshadowing its cautious outlook. Bloomberg's Abigail Doolittle says this is rare.
The guidance for the year, a range of $7 to $8 for profits. That's a little bit light relative to where analysts were, and it's 75 cents shy of where the company had been. As for the profit, though, this is a big story. They put up $1.80 in adjusted earnings in the July quarter. That is more than 300% better than what they did last year when they put up 44 cents.
Now, shares of Target right now up about 3%. And TJX topped earnings estimates and boosted its outlook thanks to customers looking to its cheaper prices. Bloomberg's Simone Foxman says it's not just about the clothing.
Of particular importance to analysts is home goods. Citi said that they were looking for an inflection point here with home spending relatively light, and they saw one. Comp sales up 4%, expected to actually decline slightly. A very optimistic note from CEO Ernie Herrmann.
Yes, the shares of TJX right now up about 4%. And Samsonite International is exploring the possibility of a second listing in the U.S., and this as a luggage maker looks to broaden its investor base. Now, sources tell Bloomberg that the move could help attract more U.S. investors for the Hong Kong-traded company. It could also provide a new avenue for fundraising. The company says it has no plans to pursue a secondary listing, but always looks for new opportunities in the best interests of shareholders and the best interests of the firm. Shares of Samsonite right now are up about 0.8%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:20 on Wall Street. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Stocks right now, they're mixed. They've been mixed for much of the session today. We did get that U.S. July industrial production, and it rose a more than expected 1%. The estimate was just 0.3% month on month, so that's a pretty big beat there. Target, it is up after earnings, and of course we get those Fed minutes later today. We'll be talking about that here on Bloomberg Markets. So right now the Dow is up about 0.2%, up 85 points. The S&P 500, it is up 0.1%, about 4 points. The NASDAQ spending most of the day lower, though, down about 0.2%, down 25 points. The yield on the 10-year right now, 4.22 would be amazing. 4.2052 to be exact is the yield on the 10-year right now ahead of those Fed minutes. NYMEX crude, it is down about 0.2% right now at $80.82 a barrel, and spot gold, it is up about 0.1% at $1,900. we'll call it $1,904 an ounce. So just up slightly. Target shares clawing their way back. Part of after some of their recent losses, at least a little bit. They're up about 3% right now after that surprising profit surge in the second quarter. And that overshadowed the company's increasingly cautious outlook, we'll call it, on the rest of the year. Adjusted earnings, well, they more than quadrupled during the quarter ended late July. But for the year, they're forecasting a cut now. Target sees fiscal adjusted earnings for the year $7 to $8 a share. It had seen $7.75 to $8.75. So that's quite a haircut there on their forecast. And that is a Bloomberg Business Flash. Guys, back over to you.
All right, Denise Pellegrini, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on that YouTube thing, so head over there and search for Bloomberg Radio or Bloomberg Global News. Joining us in studio is Doug Baker. He's a portfolio manager, head of preferred securities at Nuveen. Doug, I'm an issuer. Why would I consider issuing preferred stock? Sell me on it.
It depends what geography you're talking about. If you're talking about the United States, most of your issuance is from the bank and the insurance sector. Those two sectors, banks in particular, issue preferreds primarily to meet capital requirements.
Okay.
Insurance companies, capital requirements, but more importantly, they use preferreds to help manage their ratings.
So if I'm an investor, do I care if a stock is preferred or not when I buy it?
Oh, absolutely. I mean, because there are several components to the capital stack. And as a preferred investor, you're actually senior to the common investor. So that's first off. So compared to the common shareholder, you're senior. But the similarity with common stock is oftentimes the payments on a preferred are considered dividends. So for individuals, you get that beneficial tax treatment in a lot of instances. So you're kind of moving up the capital stack. You're a little senior.
You're safer in the event of a bust, which hopefully doesn't happen.
Yeah, you are. Arguably, you are. On paper, you are. The reality is it just depends on the situation.
Are most preferreds, are they investment grade?
Well, most of the issuers are
Most of
investment
the
grade.
okay.
Yeah, so here's how it works. If you looked at the issuers, on average, you're going to find that issuers are around a single A rated institution. However, the preferreds, on average, are triple B rated. And it's because they're subordinate in the capital stack. The rating agencies, because of that subordination, will knock the ratings down typically 4 to 5 notches versus the senior rating of that same issuer. So you have exposure to investment grade rated companies. However, the securities may not necessarily reflect that through their ratings.
All right, so we had the little mini bank crisis. Yeah. The big banks, well, everybody's going to pay the price with some, I guess, higher credit, I guess, more restrictions. How does that impact the preferred market and their use of, the bank's use of the preferred market?
So it's going to be, in our opinion, a lot like 2007, 8, 9, where a horrible situation, right? And earlier this year, not as bad, but still pretty traumatic. But looking forward, it's going to create a great opportunity. We're going to see the regulatory environment change, which is going to benefit the credit investor, which includes the preferred investor.
Okay.
And one of the things that we're seeing now is a big build in capital, or likely a big build in common equity capital going forward. So it's going to be at the expense of the common shareholder. It's going to dilute the return on equity, but it's going to enhance the credit profile for the credit investor, which includes the preferred investor.
So what do you like?
What do we like?
Yeah.
We like the big banks. We think that there are selective opportunities even in the regional bank space. We know that that's kind of, some people think that the regional banks just across the board are a risky area of our market. But if you actually do the work, you do the objective analysis, things like commercial real estate, while they're risks, a lot of these headlines that we had earlier this year, you apply some analysis, you do some stress testing on it, indeed a risk, but more from an earnings perspective, right? So we also like some of the spaces outside of our largest sectors, banks and insurance, like aircraft lessors. So you have aircraft leasing companies that are benefiting from this tremendous boom in air travel, and they're the ones that are financing the airplanes. And so you do have some opportunities in spaces outside of banks and insurance companies to play the preferred market, but at the end of the day, most of your exposure in preferreds is going to be financial services related.
All right, so if I buy a preferred stock, do I get a fixed rate, a floating rate? How does that all work?
That depends what you buy.
Okay.
And that's where I think active management can really help out, because there are preferreds out there that will just pay the same fixed rate coupon over the entire life of the security. And if that's a perpetual security, A lot of investors don't realize they're taking on a lot of duration risk or interest rate sensitivity risk with that. But there's also a large population of securities that they may start out paying a fixed rate coupon, but down the road, that coupon can adjust. And not only does that allow you to benefit from a rising rate environment, but it also helps you control that interest rate risk, which is really, I think, the primary risk of those fixed rate structures.
All right, so what's the risk to the preferred market here? I mean, I guess I got concentration risk with the financials.
Yeah, so that's the first one that we mentioned, and then the second one we were just touching on too, interest rate risk.
Okay.
Now, in our opinion, we think that the interest rate risk is probably the one that we can manage the best. Truly, though, when it comes to financial service exposure, there's only so much we feel you can diversify away from that. So we do. Oftentimes when we're having these discussions with investors and they like preferreds, they want to add preferreds, one of the things that we ask them to do is, hey, check the rest of your client's portfolio, see how much other financial service exposure is there already, because you don't want to have them take an unintended bet on a sector unless they mean to do so.
How did you first get into this? Were you doing your CFA and you're like, hey, I like this section?
Well, he went to here we go, University of Chicago Graduate School of Business, which I love the GSB moniker. They've now received $1 gajillion from Mr. Booth.
Yes.
So it's a Booth School of Business. I get it,
right.
But I'm a GSB guy. There's not a bum. I've done like a dozen Chicago MBA guys. There's not a bum in the
But they're all math people?
Yeah, well,
Yeah.
They're geeky that way, the math. You know, even our Lisa Abramowitz, who is super smart, she's an undergraduate Chicago. So they're all good. So anyway, go ahead.
But prefers, did you pick this, or were you at Nuveen and they were like, somebody's got to do preferred, man, it's you?
I hate to say it, but it's the latter. Yeah. So when I first came to Nuveen, I was actually a derivatives guy, GSB, right?
Yep.
Would you?
Sure.
And I don't tell many people this, but I was a derivatives sales guy at Lehman Brothers.
Okay.
So that doesn't come up very often anymore. You don't throw
That's
that
awesome.
out there.
So if I'm a
lead
banker,
with that.
if I'm a banker and I'm doing a new issue for Wells Fargo, you're like one of my first calls, right? You're a big buyer in the marketplace.
I would hope we're up there. Yeah. So we're typically having the conversations with syndicate desks in advance of a deal coming.
So they're whining, dining you. They're the guy. You're the
Well,
guy that they need to get to.
Whining and dining's kind of gone the way of the dinosaur. We don't get that.
See, that's why I got
But what we do is
game.
we give them the feedback. We're going to be one of the largest, typically, players in a book or in a deal for someone like that. So our larger competitors are going to get the phone call too. But the nice thing about that is we get to help drive the terms of the deal in favor of our investors. So yeah, we're typically the ones that will get the phone calls before the deal really comes to market to get a temperature check of what we're looking for.
So when Paul was on the street, it was all, and I'm sure when you started as well, you were flying everywhere twice a week. You were living out of a hotel half the time, constantly face-to-face meetings. And now, is it completely changed?
It's actually going back to that. It's
it
going
is?
back, yeah.
Good.
So we're doing. I mean, I think we're the virtual, kind of remote meetings are. That's going to be still a big component of it. But yeah, I think feet on the ground, and I think getting involved with folks face to face in a room. Look, there's just better communication that way. And it also builds a level of trust that, hey, it's easy for me to say on the phone, like, yeah, we're going to have interest at this type of level. But to do that in person, I think there's just a different connection there. And I think having that level of trust with, our partners on the syndicate side, with our investors, is truly important. So that FaceTime, that in-person travel has really picked up, I would say, over the past year or so.
How many new issues do you guys at Nuveen buy, like you, for your preferred fund? Like,
there haven't been many lately, and this is one of the technicals to our market that's been incredibly supportive valuations, and it's going to stay this way. We've had more preferreds redeemed this year than new issue can keep up with.
Really?
So yeah,
Okay.
and part of it is that as the economy slows, our outlook is banks aren't going to need as much capital because their balance sheet shrinks, right? Not as many people want loans, and if they're not making loans, well, the size of their balance sheet shrinks, and their capital is measured as a % of their balance sheet.
Yeah.
So we're seeing more redemptions than we're seeing new issuance, but when new issuance comes, use of proceeds is almost to refinance or to call an existing preferred.
And it gets snapped up because people are looking for the preferreds. There's no supply.
They're looking to reinvest their cash. And luckily for them, though, in this interest rate environment, the structures that we're seeing are very attractive. We're talking mid 7% type coupons with adjustable rate, a component down the road after the first call date. We'd be a little bit more concerned if we were in a low interest rate environment and folks didn't have this attractive opportunity. We do think that the preferreds are coming to market today are going to be a rare vintage because of these higher coupons, these attractive structures. So more often than not, we're participating in the new deals that we do see.
All right. Doug Baker, he is our go-to preferred guy, right? He's our go-to preferred guy. Portfolio manager, head of preferred securities at Nuveen. Right now, let's head down to Washington, D.C., get world and national news with Amy Mars.
All right, thank you, Paul. Legal experts are offering their predictions for former President Trump's latest criminal case concerning Georgia's election in 2020. We get the latest from Bloomberg's Nancy Lyons.
Ty Cobb served as White House counsel during the Trump years. He tells Bloomberg this is a complex case.
There's a real possibility it never gets tried or it doesn't get tried for 5 years.
Former Assistant U.S. Attorney for the Southern District of New York, Jim Zion, believes Fulton County DA Fonnie Willis is up to the task.
It might take some time before they can pick a jury. It might take some time for her to get all this evidence in. But I think that the case is going to proceed, and I think she'll try to prosecute the case expeditiously.
In Washington, Nancy Lyons, Bloomberg Radio.
Hawaii and federal authorities are trying to shelter people now displaced by last week's wildfire, which destroyed most of the town of 13,000. Hawaii Governor Josh Green says he has reopened roads in and out of some of the affected areas, although some restrictions remain.
Extremely high temperatures. We're traveling at 60 to 81 miles per hour, and it swept through, in some cases, melting metal and granite and engine blocks. That's how hot it was. So it's a very delicate scene. There are toxic metals and asbestos down there. Of course, we have the EPA and others already on the scene too.
Governor Green says at least 106 people are confirmed dead after those wildfires destroyed entire neighborhoods. Not all of the dead have been identified. President Biden and the First Lady will go to Maui on Monday. Cases of psychosis and vomiting tied to marijuana with increased levels of THC have some early legalizing states rethinking those laws. State lawmakers are focusing on the most extreme forms of cannabis, a new generation of raw flower with THC of 20% or higher, and concentrated products like extracts and vape, which rarely start below 60% THC. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:40 on Wall Street. We check the markets for you all day long at Bloomberg. I'm Denise Pellegrini. Stocks right now, they are mixed. That U.S. July industrial production number, well, that rose a more than expected 1% month on month. Target is up after earnings, and we do have those Fed minutes coming out later today. And Stuart Kaiser, head of U.S. equity trading strategy at Citi, well, he says in this higher interest rate environment, investing in tech stocks is kind of tricky right now.
As a base case, we still like tech and growth. We still think that can work because we do ultimately expect the labor market data to begin to weaken, and I think in that environment, that's kind of where you want to sit. Obviously, the last month has been pretty tough for that trade, particularly because yields have risen, pretty sharply, and that's impacted tech, I think, more than other sectors. And also this expectation story. If you're worried about high expectations, that's clearly very acute in the tech space. So I think you are fighting expectations, you're fighting performance, and right now you're fighting higher yields. But if you do think economy can weaken, and that should hopefully put a cap on yields, then I think tech is a place that you want to be in that case. But certainly the past month has been a tough ride for us.
Yeah, that's long-term, though, according to Kaiser, head of U.S. equity trading strategy at Citi, on Bloomberg surveillance earlier. But that's small consolation today because the NASDAQ, tech-heavy NASDAQ, it is lower, down 0.3%, down 35 points. The Dow, it is higher, though, up 0.3%, up 95. And the S&P 500 up just fractionally, up about 4 points. The yield on the 10-year, 4.22%, we'll call it right now. Spot gold, it is up fractionally, 1901.81 an ounce. Crude oil, it is higher now, up at $81 a barrel. That's after inventory came in a little bit lower maybe than some were expecting. Target shares, they are higher after a surprising profit surge in the second quarter overshadowed the company's increasingly cautious outlook on the rest of the year. And it's been 22 years, guys, since the last time the average 30-year mortgage rate was this high. Mortgage Bankers Association says the 30-year fix rose to an average 7.16% last week. Hasn't been there since 2001. Guys, I know you both have pretty nice mortgages, so it's just another day to sort of smile and be glad that you
Matt
did
has
what
a good
you
mortgage.
did.
I got a 6 handle, so I'm
Yeah, but you don't have a 7.16.
No, you're very right. You're very right. So I feel
Yeah.
6 is
Count
still
your
bad.
blessings,
6
grateful
is
every
bad.
day.
I got a 3.
Yeah. All right, stop bragging. Me too, but
Alex steals
I've
even
got
lower than
2.85.
that. Whoa!
And that's your Bloomberg Business Flash, guys.
Nice. Time in the market. Denise Pellegrini into capital markets.
I
Alex
heard-
Steele also has a great mortgage, she said.
Well, I think Lisa Bromwitz too. I heard her say,
Okay.
a lot of people have mortgages under 3, and I was thinking, you got a pretty good deal if you got under 3. I don't think a lot of people have under 3.
No, but what's the number? Like 80% or below something or other? I mean, which goes to the point where nobody
I would
wants
say
to sell
probably
them.
below 4.
Yeah, something crazy like that. So I'm special because I'm above that. So that's.
But
how
you
I
have
think of it.
you have an arm,
Well,
right?
don't worry. I'm going to refinance. I'm not worried about this. I'm all good.
I'm not worried for you, by the way.
I got the Jersey Shore estate. We're all set down there. All right, let's talk Hawaii. Terrible situation there. You can't get the images of the video out of your mind with the super high winds just blowing the fires. Just impossible to deal with. Now we're starting to get a sense of what the cost will be in dollars. Matthew Palazzola, he's a senior analyst. He covers all the property and casualty insurance companies for Bloomberg Intelligence. He's been doing this on the street for a lot of years, first at Merrill Lynch and now at Bloomberg. Matt, thanks for joining us here in our Bloomberg Interactive Brokers studio. Where are we now in terms of trying to estimate what the costs will be in terms of dollars and cents here?
Yeah, so the way it goes with these events is usually what happens is the street will try to estimate them maybe up front. We did a scenario analysis. We pegged 2.5 to 4.5 billion of insured losses. Then what happens is catastrophe modeling companies come out. So there's a company, KCC, they're usually first out with things like this. They analyze satellite imagery. They kind of have a bunch of proprietary models. They just came out with a number of $3.2 billion in property losses.
Property losses, okay.
So is this situation different than those that we see in places like Florida? Yesterday, I think it was just yesterday, right? We were talking about the fact that a lot of those places that get hit time and time again aren't really insurable, so they have to get insured by a state fund, which ends up getting taxpayer backing. Is the Hawaii situation different?
It is different. So Hawaii's not very catastrophe prone. so they don't usually have a lot of events. It's actually the cheapest home insurance in the country.
Really?
Yeah, because there's not a lot of events. Fires happen there,
It's
but
crazy. It's a little island sitting out in the middle of the Pacific Ocean. You'd think they'd be prone to
things
stuff.
miss it. What's interesting is there was a hurricane passing south,
Yes,
which
that was the problem.
fed a lot of the winds there. But insurance availability is not a problem in the state, so it's not very similar where a lot of the stuff will fall on taxpayers.
And just from the insurance company's perspective, the numbers you're quoting, 2.5 to 4.5 billion, maybe a midpoint of that number, that's not a problem.
It's not.
That's
it's
normal
not
course
a
of business.
big loss. I mean, that will probably not even impact the reinsurance market, meaning primary insurance companies will retain most of that loss themselves. Up to even 10 is probably what you call maybe manageable. So this is, in the end of the day, probably kind of a blip for the industry.
So, but the premiums will be raised for the people out there.
Assume so. I mean, usually what happens is, you kind of have an event, it brings things to light. We talked about here before, wildfires increased over the past century 400% in the state, and it probably was underpriced. So you'll definitely see premiums go up in Hawaii, sorry.
All right, so I'm looking, you've got in your research note kind of who the big insurance players are there, and in homeowners, it's State Farm. For commercial property and stuff like that, it's Tokyo Marine. If I'm a State Farm shareholder, again, how concerned am I about this?
So State Farm, they're not a public company, they're a mutual company,
that's right.
so there are no shareholders.
And they insure the Sweeney compound.
Hey,
well.
me too, buddy.
There we go.
High five, guys. Yeah, I mean, State Farm, the mutual model, they don't have shareholders, they're not public. They kind of operate at higher losses, probably maybe better prices. I'm not sure what prices you guys are getting, but I'm
getting a good price.
There you go.
So I was Chubb, and they kicked me out after a claim.
Well,
and then I realized they're very expensive.
They are very expensive. I think the what you're getting, maybe what you pay for a little bit there, they're good on claims, but perhaps in your case, then they boot you out. But
well, you ride a motorcycle with 800 miles an hour.
Well,
in New York City.
No, I'm not allowed to ride in New York City anymore.
Okay,
that
says who?
After that accident,
says your wife,
my wife and my mother have both forbidden me to ride in and out of Manhattan.
You don't carry your Picasso with you while you're riding the motorcycle? No?
Anyway, the claim was a Porsche claim, not a motorcycle thing.
Okay.
Yeah.
Porsche.
We don't need to get too deep into it.
Let's just stay away from that. All right, let's step back a little bit here. Talk to us about kind of how we are this year in the insurance business. How's the business been for the insurers?
Fundamentals are good. Higher interest rates good for the industry. I think was an interesting story is the reinsurance market. We talked about that a lot. It's insurance for insurance companies. The prices there are going up.
What's it just for me? Sorry to interrupt. What's the reinsurance company? Like, give me a name that I can.
So there's a
Munich Re.
Munich Re. Okay.
A lot of them are in Europe.
Hanover Re.
There's a
Swiss Re.
Swiss Re. Those are the European ones. We cover mostly them in Bermuda. So the pure play is called Renaissance Re. Tickers.
So you get to go to Bermuda
every once in a while.
Nice.
But yeah, so the pure play reinsurance company there is Renaissance Re R&R. A lot of them are hybrid insurance and reinsurance.
All right, we only have a minute left, but are you wearing a moon watch? Is that a baby blue moon watch?
I can't believe you saw that. Yes, I am.
That's so cool. Hold it up to the camera. The camera's right in front of you.
Okay, there we go.
So you've got the Uranus moon watch,
Yes, I didn't want to say
which
it.
is a very cool collaboration between Omega, the Bond watchmaker, and Swatch.
I got
because they're
Omega.
you have an Omega
Seamaster,
Seamaster, right?
Yep.
So the moon watch is basically the speed master, right? So, but that's famous because Buzz Aldrin, I think, actually wore it on the moon.
Okay.
And now they've done this collaboration that's so cool. I really want to get one, but I can't decide which planet. They make one for each planet.
Are these really expensive?
No, they're not very
super expensive. You go to Grand Central, they get a couple in every day.
They're just hard to find. Exactly.
Yes, they're hard to find.
You go to
get them in
Grand Central?
Grand Central has a Swatch
They have a
store.
Swatch shop.
Okay.
So
And
you can't buy them online is the thing. So you can't go on Swatch.com and buy them. You have to go to a store when they have them, and they only make them when there's a full moon.
I didn't know that.
So that's when they produce them. So they're a limited quantity.
Did you know that?
I didn't know. I knew some of
I'm
this.
an insurance guy doesn't know that.
That's a very cool,
So you
very
would
cool
know that,
watch.
but-
Good get, buddy.
All right, nice. See, it matches his pants too. That's insurance guys. You think they're just kind of nerdy kind of guys, but these guys are pretty stylish.
These guys are searching.
In financial services, Matthew Palazzola joining us here on the Insurance Biz. Let's get some company news right now. Lisa Mateo.
Always learning something new here on Bloomberg Markets. Good morning. Business leaders, well, they aren't the biggest fans of remote work, but they know it's here to stay. That's according to a study from the Federal Reserve Bank of New York, which has about 2/3 of those surveyed feel working from home had a negative impact on workplace culture, cohesiveness and team environment, communication among employees, and also training and mentorship. But on the flip side, more than half said that remote work makes it easier to recruit staff, and more than 2/3 said it helps them retain them. Well, FedEx is pressuring its delivery contractors to impose safety after a rising number of accidents nearly tripled insurance costs over the past 10 years. Bloomberg's Gina Cervetti has that story.
Memos to contractors show that FedEx is requiring drivers making deliveries for its ground unit to install vehicle cameras and sensors, among other steps. But some current and former delivery contractors said FedEx is not addressing the structural challenge of high driver turnover.
Well, maybe FedEx should have talked to our last guest. Shares of FedEx right now, they are down just a fraction. And it's getting even more expensive to afford a home. U.S. mortgage rates rose last week, matching the highest in more than 2 decades. Yes, since 2001. Now, the contract rate on a 30-year fixed mortgage hit 7.16%. That's according to the Mortgage Bankers Association. And that pushed home purchase applications to slip for a 5th straight week. That was to the second lowest level since 1995. Now, the jump in borrowing costs is not what the housing market really needs right now, as it just had been starting to show some signs of finding its footing. Well, those are the company stories that we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
That is us, Matt Miller, Paul Sweeney, here in the Bloomberg Interactive Brokers studio, looking at these markets here. We're actually looking at the Omega Swatch watches is what we're doing.
The different moon watches.
The different moon watches, yeah.
Have.
Those are cool.
Some of them they're each named for a planet, right?
Okay.
So you can get, they're called mission. So you can get mission to the sun. It's not a planet, obviously, a star, mission to Mercury, mission to Venus.
Okay. And what did Matthew Palazzola have? He had the blue one.
He had the light blue one. So that is Uranus.
There you go.
Which
right.
he didn't want to say the name of the planet.
Yes.
What a child.
Yes, exactly. He doesn't know we're adults in here. All right, S&P 500 unchanged. Dow, a little bit of movement. NASDAQ off 0.4%. Let's get to the news right now. We'll do that with Amy Mars.
All right, thanks, guys. The slow process of rebuilding Maui is getting underway bit by bit. The road leading to West Maui has been reopened. Downtown Lahaina still off limits. Maui Mayor Richard Bisson says there's still a process in place to help reopen this town, and it's got to happen in phases.
Once we've determined that to be a safe zone, and the EPA has gone through there, and they have removed all the hazardous and toxic material out of Hawaii, then we can begin the debris cleanup, which is a different phase, and then at some point allow landowners and homeowners and business owners to return to that location.
The death toll in Maui is now at least 106. President Biden and the First Lady are set to be there on Monday. President Biden is also holding his first international summit at Camp David on Friday. He'll be hosting the leaders of Japan and South Korea.
Secretary of State Antony Blinken says it'll be the first visit to Camp David by foreign leaders since 2015. He says the meeting will give them a chance to discuss shared concerns about security in the region.
From physical security to economic security, from humanitarian assistance to development finance, from global health to critical and emerging technologies.
Blinken says it's also likely the nations will hold regular three-way meetings in the future. In Washington, I'm Nancy Lyons, Bloomberg Radio.
UPS union members have until August 22nd to vote to approve a new contract. Teamsters leadership in the company agreed to new terms before the last contract expired last month, but employees still have to sign off on it. Local union leaders are in favor of the deal, which gives raises to full and part-time workers. What was once TweetDeck is now a subscriber-only product after Twitter rebranded and became X. TweetDeck became known as X Pro, and yesterday X Pro users were told they'd have to pay $84 a year and get a blue check mark if they want to keep using that service. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
All right, Amy Mars, thank you so much. We appreciate it. Another deal from our good friend in Omaha, Nebraska. Billionaire Kelsey Warner's Energy Transfer LP will buy Crestwood Equity Partners in a $7.1 billion all-equity deal that will create a major expansion of its pipeline networks across the U.S. There's deals getting done in the energy space in a big way here, and I think
especially pipeline deals.
Yeah.
So pipelines for gas, pipelines for what do they call it when they bury carbon? That's also a big a burgeoning industry, that carbon capture, exactly.
Carbon capture.
That we've seen a couple of deals over the past few months. So
you
just
can't
for
build a
that
new pipeline, can you? I mean, it's almost impossible to build a new pipeline.
There was a Business Week story a couple of months ago about how difficult it is to get all the permits that you need to build pipelines, right. And it takes years and years.
Because we don't want the elk and the caribou to get
right.
So
even if you want to build a pipeline for the purposes of saving the planet, it's still going to take way too long.
I mean, we're doing all the shale stuff, so how do they get it? Like, that's a problem, like all the shale from Pennsylvania, you can't get that nat gas to New England.
Right. You got to, liquefy it and put it in a truck and drive it?
Yeah, because you can't put it on the high seas because there's some law that says you can't do that. So the people in New England buy a lot of their nat gas from Europe.
Business Week has done a lot of reporting on this, and I recommend you go back and check that out.
Right, little M&A trade in the energy space. I always like to see that. WTI crude oil pretty much unchanged on the day, about just under $81 per barrel. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up, a lot to cover in the next hour, starting off with Caroline Frederickson, distinguished visiting professor at Georgetown Law. She's going to join us to talk about the Trump indictment, where we go from here with the indictments, plural, I guess. Lisa Sturvant, chief economist at Bright MLS, to talk about the real estate market. Mortgage rates 7.16, the highest in a very, very long time. And then we're going to get kind of a roundup on what we're seeing in the retail space. Marie Driscoll, senior analyst with Coresight Research, breaks down some of the numbers we've seen from some of the targets, the TJ Maxx's. We got Walmart tomorrow. We had the retail sales numbers out yesterday. So a lot to talk about there about retail and the consumer. We're going to kick this hour off in style with Charlie Pellet. Charlie.
Hi, thank you very much. Right now we have got stocks trading mixed. The Dow holding on to a gain of 0.1%, up 35 points. S&P, little change right now, down less than 0.1%. The S&P lower by 4 points. NASDAQ, though, down 70, a drop there of 0.5%. Gains in the S&P 500 petered out on volume that is 20% below the 30-day average at this time of the day. Tech-heavy NASDAQ 100 index edging lower now, down 54 points, down by 0.4%. 10-year yield 4.22% with a 2-year that's yielding 4.94%. Spot gold virtually flat on the day at $19.02 the ounce, up 36 cents, while West Texas Intermediate crude is down 0.1%, $80.89 for a barrel of WTI. Target shares higher after a surprising profit surge in the second quarter overshadowed the company's increasingly cautious outlook on the rest of the year. Target up now by 3.1%. Jen Bartashis is a senior analyst with Bloomberg Intelligence, and she was interviewed this morning on Bloomberg Markets.
When we look at Target, what the market likes is that margin is up, and it's up significantly over last year. At the same time, I think everyone recognizes that it's a difficult operating environment, and so even though Target reduced its full year guidance for sales and for profit, I think that people are encouraged by the way that margins are responding, even in that environment.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Again, Target shares are up 3.2%. TJX, the parent of Home Goods, and TJX, among others, reporting earnings that came in better than expected. Shares up by 4.7%. Walmart tomorrow. Walmart down 0.3%. Again, recapping here, S&P now down by 2 points, down less than 0.1%, just under 2 hours to go until the latest Fed minutes. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. How cool is it that we get Charlie Pellet promoting our podcast?
That's a big deal. Yeah, I heard that too.
Now, he should be doing that on the subway after watching The Closing Doors. Say, hey, by the way.
Yeah. Stand clear of the closing doors and download the tape. Yeah.
I don't know why he's not doing that for us. Charlie Pellet, thanks so much. We appreciate it. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Brokers studio. We are on a live stream on that YouTube thing, so just head over there and search Bloomberg Global Markets or Bloomberg Radio, and that'll get you where you need to go.
Dude, is it Bloomberg Global Markets or Bloomberg Global News?
Yeah, you're right. Bloomberg Global News.
Okay.
Thank you for the correction there. It
So
should be either.
I just got done telling my wife. So you go to youtube.com and then you just search Bloomberg Radio. It's much easier because those are only 2 words to remember.
Yeah.
And then you can see us live.
And that works?
Yeah.
That works. Okay, we'll go with that. All right, let's talk about these markets here. Not a lot happening on the index level, but there's always stuff under the hood. And Belly Lipschultz, he's covers all the Bloomberg markets for Bloomberg News. He joins us here in our Bloomberg Interactive Broker studio. Belly, what are you looking at?
Yeah, S&P 500 volume is about 20% below the 100-day average. But as you mentioned, we have some stocks in the green, some stocks in the red. Progressive right now up 8.9%. One of the biggest jumps since 2020. after analysts said the monthly results showed an improvement. Companies' net premiums written for July of about 20% year over year. So you're looking at the top performers in the S&P 500. You've got Progressive, you've got Allstate, and you've got a number of other companies in and around that space.
Yeah.
Other outperformers, TJ Maxx and Target, like Charlie hit on after results, and this all coming ahead of tomorrow morning. Walmart, big focus for Walmart, will be their outlook for holidays and the back-to-school shopping season, which I know, Paul, you mentioned you don't really like to look at summer winding down, but I know when I hung out in my building over the weekend, all anyone talked about were their kids going back to school.
Is that right? Well, I mean, a lot of parts of the country, like California, done. They've been back. A lot of parts. I mean, you're a California dude. I mean, I was shocked the first time I was out there this summer, and our pool, our community pool in Carmel Valley, shut at like the end of July or something like that. I'm like, what? And they say, oh, everybody's going back to school. We shut down. I say, we're only halfway through the summer, dude. They're different out there.
That's wrong. Back to school should start in September.
It should be a Labor Day thing.
We shifted at my high school. It was a long, drawn-out period to get in line with the college schedule. So we finish our first semester before winter break and then pick up, and that's why we're done in May, but go back mid-August, which is
that's just not right.
Weird stuff.
But back to school, you don't know this yet, but when you're a parent, it's like summer vacation is approaching, essentially. It's like flipped, right? Because all of a sudden your kids are going to be gone for 7 hours a day, and it's glorious.
I was hanging out in my building's pool over the weekend, and they were like, negative, we have to make lunches again every night. But the positive is that they're out of the house. We don't have to worry about getting them to daycare or some sleepaway camp.
Yeah.
All right, what else you got for us here?
Another stock that started out in the green but is now in the red, Coinbase, that coming after they want approval to sell crypto U.S. futures.
I mean, this is big news. I think this is very big. When did they apply for that license?
All right, so what is the story again? Because most of us don't care about crypto, so let's do it again.
Coinbase got approval to sell cryptocurrency derivatives directly to retail consumers here in the U.S.
So futures.
Yes.
Futures, exactly.
I took that class.
That coming...
I traded futures.
So that'll launch in the next few weeks. But Matt, I mean, was this... You follow the crypto space, arguably, if not acknowledging it more than I do.
I'm probably the same, right? Because you follow... Your main title is what? Meme stocks guy?
Oh my gosh. Everything that your friends invest in.
Those two circles touch on the Venn diagram. We overlap for sure. But Coinbase has applied for this. They've been essentially... using third-party brokers.
Okay.
So until now, if you wanted to buy, say, Bitcoin futures, right, and you would call up Coinbase, they'd say, sure, no problem. Let me hook you up with, Jim Brown, who's going to, do the deal for you. Now they can do it themselves since they got this license from the NFA, which is the National Futures Association. So there'll be a futures commission merchant, and they'll be able to offer these directly. And I want to say it's been at least a year since they applied. No, early 2022 is when they bought FairX. That's how they can do the third-party stuff. And it's been at least a year since they applied for this license.
So it's off. The stock's off 1% today, but it's up 120% year to date.
Yeah, that's the big thing. It started out in the green, much like a lot of stocks. I look at Kava. It's kind of that whole, these stocks that have been outperforming are on losing streaks. Interesting thing with Coinbase, 6-day losing streak. So longest stretch of decline since early April. Bitcoin, though, also is down 0.5% back towards the $29,000 level. So really just a proxy of...
No volatility in Bitcoin. Isn't it like far less volatility than in stocks lately? I think they're about 30,000 now, and where are we? The middle of August. It was the middle of June, I want to say, when they got to that level. So it's been 2 months that Bitcoin's just hanging around at 30,000 with zero movement.
Yeah, the peak, as you mentioned, we saw that big rally mid to late June, up just north of 30,000. And when you have
we were down at like 26, and we came back, and now it's been stuck there.
Yeah, it's also interesting. I mean, you look at Bitcoin, and it's so interesting, such an interesting debate of, is it, when it goes up or outperforms the market, it's a safety play. When it underperforms the market, it's because we're risk off. We saw that swing from 16,000 at the end of last year up to, 30,000 in April, and it's like, we're getting so much momentum from your institutional players. PMs are now buying into it. The whole kind of shift of the way it's being viewed on Wall Street is changing.
And the rally was because of the BlackRock ETF filing.
Is Bitcoin, do we talk less about crypto than we did 6 months ago?
Sure.
Why is that?
Far less. because there isn't a lot of movement. The thing that made Bitcoin exciting wasn't that it's $30,000 a coin, which, by the way, to me, that's still mind-blowing.
Yep.
This line of code is worth $30,000. I mean, I remember when kids were mining Bitcoin with Nintendo 64s, when it was a matter of pennies per Bitcoin, and now it's $30,000. And but when it stays there, it's not as exciting. It has to either fall dramatically or rise dramatically. And of course, when there are big collapses, like an $8 billion collapse of FTX, then we're going to cover it for months. But if it just sits there after a while, we're only going to talk about it when, like, Sam Bankman-Fried gets moved from his Palo Alto house to MDC in Brooklyn.
When is that trial happening? Do we know? Has that been decided on? We haven't seen that date, have we?
I do not know, and it's still a ways off.
Yeah. That's going to be must-see TV if it happens, or if they come
Yeah, but that
to a
won't
plea
be
deal.
televised
No.
like the
Yeah.
Georgia trial.
The Georgia trial is going to be televised. Ay. All right, Bailey, anything else here?
One of the things that we had been tracking and talked about it a touch earlier, looking at Coherent, CORH.
Yep.
Oh, HR, sorry, English. Down 35%, disappointing outlook. When you look at this stock on a 12-month basis, absolutely underperforming.
Yep.
This whole SOX AI excitement, trading at about $30 was, closer to 60 this time last year. So sitting out and missing out on that big rally that we've seen across chip makers.
All right, Bailey, thanks so much. Bailey Lipschultz covers all the markets for Bloomberg News. Let's get right to our next guest, Caroline Fredrickson, distinguished visiting professor at Georgetown Law. Caroline, thanks so much for joining us. We'd love to start as it relates to former President Trump and his legal challenges. Why, maybe, just give us a sense of kind of where his greatest exposure is with these four issues that he's facing from your perspective.
Well, I mean, there are four prosecutions, but there are a lot more than four issues. So, it looks, I guess I would start by talking about which are the most consequential. We could look at both the cases that are brought in D.C., the federal case focusing on January 6th, and the Georgia case is really being central to the concern that we have about President Trump allegedly trying to undermine our very democratic system. The other two cases, albeit important, don't have the same kind of real existential issues for the United States of America as continuing to exist as a democracy. Now, in terms of what the the ultimate greatest danger is for Donald Trump, we'll still have to see how this will unfold because we haven't seen either of the prosecutors lay out their case. I think there are a couple of different theories here, and one is that the approach taken by the Department of Justice, which has been not to name the so far unindicted co-conspirators, but to really move in a different and more focused way, is one strategy to try and really focus the attention on Donald Trump and perhaps behind the scenes to try and negotiate with those who haven't been named yet in the federal lawsuit, to include some of the same people who were actually named in the Georgia state prosecution, the Fulton County prosecutor. In that case, you have 19 defendants and 41 charges. I think they're taking a very different strategy, which is very narrative, which is telling a story and working on the potential of the defendants there turning on each other, some of them taking plea deals and so forth. So they're both very consequential for the president. It's really hard to say that they have both significant prison time for him if he is prosecuted.
I want to ask Professor about something I saw in the Times over the weekend that I think a lot of people probably read, bringing up the possibility that according to the original meeting of the 14th Amendment, Donald Trump is ineligible to hold government office. And there was a paper written by a couple of, I guess, attorneys that are or were associated with the Federalist Society. So this is coming from a fairly conservative group, right, in which they argue that because he essentially engaged in insurrection, he is barred from holding office due to this amendment that was put in place after the Civil War. Does that hold any water, do you think?
I think it's a very strong argument. And first of all, I'd say they're actually law professors. One of them, Will Bode, is at the University of Chicago. It's very
exactly, and Michael Stokes Paulson from the University of St. Thomas.
And they're very conservative, associated with the Federalist Society, as you said, but also originalists. And I think in the sense that they went back and they looked through a lot of the documentation around the debates, around the amendments, adoption, and it was clear they were not just focused on those who'd been guilty of treason during the Civil War, the Confederates, but was meant to be prospective and keep people who've taken an oath of office to the United States from being eligible to serve again in such positions of trust. There has been, was brought by a group called Citizens for Responsibility and Ethics in Washington against somebody who participated in the January 6th insurrection, and they kept him from being able to get elected. So I think it's a very strong argument, and I think we're going to see how that will play out as election officials take action in different parts of the country.
Caroline, what's your sense of the timeline here with these 4 cases? When will the first one, what's the timeline as you understand it?
Well, it's very fluid right now. I mean, I think the special prosecutor is trying to move forward as expeditiously as possible. And it looks like they're going to try and get that trial started before the end of the year. I mean, these things are, can keep changing. The Mar-a-Lago documents case looks like it's going to start really underway in the spring. The Fulton County prosecution in Georgia, I think that's, they have an interesting schedule. There's speedy trial rule. That means that any one of those defendants can demand speedy trial, which can really accelerate the pace of this that prosecution, meaning that it could even be starting mid-fall, October or November, and those cases could be divided because some of the defendants might commit, agree to a plea or otherwise get severed.
All right, we'll have to, obviously, fluid situation, as you mentioned. We'll stay on top of it. Thank you very much for your time. Caroline Frederickson, distinguished visiting professor at Georgetown Law, trying to give us a little bit more clarity as this legal issues of the former president continue. We'll have more coming up. This is Bloomberg. We have company news right now with Lisa Mateo.
Thanks, Paul. The price of Amazon Music is going up for Prime members. Starting on Saturday, the cost of the Amazon Music Unlimited individual plan will increase $1 from $8.99 to $9.99 a month. Now, the family plan, that's going to rise $1 too. Apple Music, Spotify, YouTube Music, they've all already hiked their prices. Amazon shares right now down about 1.5%. Meanwhile, Tesla cutting prices once again in China for the second time in 3 days. Bloomberg's Kimberly Adams has more.
The company reducing the price of Model S sedans and Model X sport utility vehicles by nearly $10,000. The move coming just 2 days after Tesla marked down the long-range and performance versions of the Model Y SUV and extended an insurance subsidy for the base version of the Model 3 sedan. The cuts are fueling concerns the car maker is reigniting a price war.
Now, shares of Tesla right now down about 2.5%. And Target's strong profit rebound in the second quarter is overshadowing a cut to its profit outlook. Bloomberg's Gina Cervetti reports.
The latest results reflect progress in working through bloated inventories that forced steep markdowns a year ago. Target did post a sales decline, and that was the first one in 4 years. Revenue during the latest quarter took an extra hit from the controversy around Target's Pride Month collection of goods.
Now, shares of Target are up about 3%. And TJX swept past estimates for the second quarter and raised its guidance as customers look for cheaper alternatives. Right now, shares of TJX are up about 4.5%. Those are the company stories we're following this hour. I'm Lisa Mateo.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We've got the Dow, the S&P, NASDAQ, and the NASDAQ 100 index, and the Russell 2000, all trading lower right now. Red on the screen. Equities and treasuries had been wavering, but right now lower across the board as we await minutes from the Federal Reserve's last meeting. We get those minutes at 2 p.m. Wall Street time. Here's where we stand. The S&P's down 10 points now. That is a drop of 0.2%. The Dow down 24 points, giving up earlier gains as well, down 0.1%. NASDAQ, the composite index, down 0.7%. NASDAQ 100 index down 0.6%. Small cap shares, the Russell 2000, lower by 0.6%. 10-year yield right now, 4.22%, with a 2-year that's yielding 4.94%. And spot gold is down $1.50 the ounce to $1,900 now, a drop of 0.1%. Bitcoin lower by 0.7%, 28,952 on Bitcoin. So it is a down day for the Dow, the S&P, and NASDAQ. Energy Transfer is buying Crestwood Equity Partners in a $7.1 billion all-equity deal that will allow Energy Transfer to expand its pipeline networks across the United States. Energy Transfer shares, they're up 2.3%, and shares of Crestwood Equity Partners, they're also trading higher, up now by 3.5%. Again, recapping, it is a down Wednesday here with the S&P down 10 points, a drop there of 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, thanks very much. Paul, we were talking about Sam Bankman-Fried and the trial.
Yes.
Before, I didn't know when it started. I just shot Hannah Miller a message. She's the host of the podcast about kind of the downfall of Sam Bankman-Fried. It's called Spellcaster. It's a great podcast.
It is.
And she says the trial date is set for October 2nd. She says neither side wants to delay, so they're expecting it to move forward as planned. So we do have indeed a date set in stone.
That's quick. That's a lot sooner than I would have thought. Okay, we'll stay on top of that, of course. All right, let's talk about the housing market, the residential real estate market. U.S. mortgage rate climbs to 7.16%, matching the highest since 2001. That gets your attention,
That's if you have great credit.
Yeah. And
that's the gold standard mortgage rate. Because if you look at bank rate, we're already up over 7.5.
That's right.
Yeah.
That's right. So we need to figure out what's happening out there and what it means for this market. Lisa Sturdivant, she joins us. She's the chief economist at Bright MLS. Lisa, we had some housing data come out today. Housing starts pretty strong. I guess the housing industry, the home builders are trying to meet the demand out there. But what's going on in the residential real estate market today? How would you characterize it?
Yeah, it's such a strange housing market, isn't it? It's housing has really confounded expectations in so many ways. You point to the home builder data this morning. New housing starts are up from a year ago, up from last month. We're seeing that home builders are really responding not only to the demand in the housing market, which has stayed surprisingly resilient despite those higher mortgage rates, but they're really responding to the fact that inventory is really at near record lows, and there really is so little for prospective home buyers to choose from. Home builders are ramping up. The amount of inventory that's accounted for by new home construction is at its highest levels really in the last couple of decades, and it's been a really strong housing market. We may be, though, prepared to see some changes in the market as we head into fall.
So what do you think the catalyst for that will be? Because I don't know what's going to move us out of this stalemate that we're kind of in right now. Owners who have low mortgages don't want to sell, and buyers can't afford the high mortgages or the prices.
Right. So we sort of expected back a year ago when the Fed started raising rates and mortgage rates were rising that we would see a real strong pullback in demand. Maybe home prices would fall. But in fact, aside from a slowdown late last year, we've seen buyers back in the market in record numbers in the spring, primarily because there's just such strong demand for home ownership. A lot of folks have record levels of equity in their homes that they're able to roll into a home purchase, in essence, sort of buying down that higher rate. But as you point out, the real reason why home prices have remained firm so far is inventory has been locked down as many homeowners are in those sort of golden handcuffs of lower rates. But I think we're at a point now where there's just a lot of fatigue in the housing market, and rates surpassing 7 or even 7.5% could be what send us to a much slower market in terms of transaction level here this fall.
So a lot of folks are wondering, like myself, when mortgage rates are going to decline. And is there a level that once we get there, that'll maybe free up some activity here? Is it 5%? Is it 6%? Is it 4%? Is there a rate where you think it would kind of thaw out this market?
Sure, yeah, right. It's not going to be 3%, right? It's not going to be back to where we were during the pandemic. I don't think it has to come down even to 4 or 5% to help free up some sellers who may be waiting to move but feeling that financial pinch. You know, one thing that we're tracking really closely is the fact that the spread between the yield on the 10-year Treasury and the 30-year fixed rate mortgage still remains quite wide. So even though mortgage rates will remain relatively elevated here in the latter half of 2023, if we do expect, and I think we do expect that gap between Treasury yields and rates to begin to narrow, and we could see rates come down to below 6% next year, which I think is what will be enough to bring more sellers from the sidelines.
What's an historical, what's a rule of thumb in terms of that spread? Where is it typically, or has it been over, say, the last 20 years?
Yeah, we're typically around maybe 1.82 percentage points, and we're now up at 3 percentage points.
So historically, we should see mortgage rates about 6, right? And we're looking at a little bit more than 7.
That's right. And so if you imagine sort of as we move through the rest of the year that we should expect rates to come down, maybe settling around 6.5% by the end of the year, and continue to come down further as we head into next year.
All right, so I guess I'm refinancing, with a 5 handle. So,
what,
all right.
What about, Paul top ticked the mortgage market. But he got an arm, so he's ready to move in and pounce when the rates come back down. What about new supply coming on the market? So we know that there are very little transactions in terms of previously owned homes. Are builders out there putting up new supply like crazy so they can get them into the hands of home buyers who are willing to either pay cash or go with a 7% mortgage?
Yeah, there's been a long period of time during which home builders had a really tough time with supply chain issues, difficulty getting materials and labor. And now over the last few months, we've really seen home builders ramp up construction because there's just simply no other inventory out there. And they are having to do things to entice buyers in, though. We're seeing more builder financing. We're seeing
builder financing at lower rates, right, Lisa?
That's right. I'm sorry. Builders offering financing at lower rates to help bring more buyers in. What we're not seeing is builders dropping prices of new construction yet. And maybe they won't have to as we head through the rest of the year. But we are seeing, some sort of givebacks in terms of upgrades and other things. But right now, there are a lot of home buyers who are on the lots of new houses and they didn't expect to be, but that's where they are because that's what's available for sale.
I mean, why would you drop the price? You put up a bunch of McMansions in, Connecticut commutable area, and then if you say, hey, we'll give you a 4.99% mortgage, people are like, wow, I'll pay whatever you want.
Right, and it definitely is region specific, right? We have some parts of the country where we're not seeing as much home building. Here in the Washington area, for example, we're still seeing home prices of existing homes rising even as demand has slowed, and that's simply because we're not seeing a lot of new construction that's been coming online.
So when the home builders are out there building, and again, building permits, housing starts up 3.9% month on month, much better than a forecast here this morning. What are they building? Are they building those McMansions, or are they building what the market really needs, which are starter homes?
Well, the market needs starter homes for sure, but it has been a long time since we've seen new construction really be the main supplier of starter homes. But what we are seeing is a range of new construction activity in that middle market as well as that luxury market, which then allows the starter homes in the existing stock to be vacated, where folks are able to move up. I mean, it's part of a whole housing ladder, right? But because of the cost of materials, the cost of labor, the cost of local regulation for home builders, it's really financially challenging for a builder to build at very low home prices. So we're really seeing sort of mid-market and luxury construction by and large.
What about multifamily?
the rental market has been certainly going like gangbusters in many markets. In fact, we've seen that rents are beginning to come down year over year on a national basis. Rents are down in many markets across the U.S. This is all happening despite the fact that mortgage rates are higher. We're seeing just more new rental construction coming online, which is giving renters more options. So if we're looking for some sort of bright side in the housing market, people who are in the rental market are finding more options and are finding rents stabilizing or coming down.
Hey, Lisa, thanks so much for joining us. I really appreciate getting your thoughts here. Lisa Sturdivant, Chief Economist for Bright MLS. And on the housing market locally, Matt, you'll be pleased to know that Aaron Rodgers, quarterback for the New York Jets, he did find a house in New Jersey. $9.2 million. It looks like a really awesome house, man.
And cash purchase, I'm going to
probably.
Guess,
he's
right?
got just amazing views of the city and all that kind of stuff. So it looks like he's going to be here for a few years.
Even if he's not, it's still a great place to buy a house, right?
New
Good
Jersey,
place to
of
invest.
course. I mean, come on.
Yeah.
You know, it's what else? I mean, I should be getting paid for this, supporting the state of New Jersey.
The armpit of America.
Exactly. Thank you very much. My home. So anyway. So I'm glad to see Aaron Rodgers has got his crib here in New Jersey.
Are you a Jets fan?
No, I'm a Giants fan. But,
okay.
I'm a New Jersey fan, so he bought this amazing house, so good for him. All right, let's head down to Washington, D.C. We get world and national news with Nancy Lyons.
Thanks, Paul. President Biden and First Lady Jill Biden will be traveling to Maui Monday to see the devastation from the recent wildfires. Biden has come under fire for refusing to comment on the disaster over the weekend while he was vacationing in Delaware. In a statement today, White House Press Secretary Karine Jean-Pierre said the president has committed to delivering everything the people of Hawaii need from the federal government. The Bidens will be meeting with first responders, survivors, and local officials. The death toll there is now up to 106. President Biden today is focusing on the successes coming from the Inflation Reduction Act, a year after it was signed into law. But Bloomberg's Anne-Marie Hordern says it's been a challenge for his message to break through.
We have a big PR problem, and they realize that, and they're trying to advance it today on the one-year mark, but also going to key places like Wisconsin, like Arizona, like Nevada to talk about it.
Bloomberg's Anne-Marie Hordern in Washington. Among those who've now weighed in on former President Trump's fourth indictment is former Vice President Mike Pence. The latest charges involve Trump's alleged interference in Georgia's election results in 2020.
The Georgia election was not stolen, and I had no right to overturn the election on January 6th.
Pence was speaking to the National Conference of State Legislators in Indianapolis. Trump and his 18 co-defendants have been given until next Friday to voluntarily surrender to Georgia authorities. Well, a week from today is the first Republican presidential debate, and with frontrunner Donald Trump refusing to commit to going, Florida Governor Ron DeSantis is expected to take the brunt of the attacks from his opponents. Aides say DeSantis and his debate coach have been practicing at least once a week. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are wobbling. We have got the Dow back in the green, barely up 7 points. That is a gain of less than 0.1%. A little changed, as is the S&P, down 7 now at 4430, a decline of just under 0.2%. Nasdaq, the composite index, down 83 points, a drop there of 0.6%. The Nasdaq 100 index is down 0.5%. It is now trading at its lowest in more than a month. 10-year yield is 4.23%, with the 2-year that's yielding 4.94%. Gold at $1,900 even, now down 0.1%. West Texas Intermediate crude down 0.8%, 80.32 right now for a barrel of WTI. Just about 1 hour, 19 minutes to go until we get the latest FOMC minutes for investors. One of the big questions is whether interest rates stay higher for longer. Danielle DiMartino Booth is chief strategist at QI Research, and she weighed in on that topic this morning right here on Bloomberg Markets.
You know, if you look at what a lot of people are starting to believe compared to 12 months ago, now they're saying we might not see quantitative tightening stop until the fourth quarter of 2024. That is a form of higher for longer, even if we see rate cuts in 2024.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Target shares higher after earnings. Target now up by 3.6%. Walmart reports tomorrow. It is down by just about 0.1%. And briefly, Visa facing fresh scrutiny from the Justice Department over how it charges merchants for technology it uses to protect cardholder information. Recapping, S&P down 6, down 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio, also streaming live on YouTube. Just head over there and search Bloomberg Radio, and that works just fine. A lot of retail data coming out. We had retail sales yesterday, really strong. We're starting to hear from some of the retailers, Home Depot, TJ Maxx, Target, and tomorrow we get Walmart. Let's kind of break it all down with Marie Driscoll, luxury retail analyst at Coresight Research. Marie, it appears just from looking at the past couple of days, some of the retail sales numbers and some of the results we've gotten from some of the big retailers, the consumer seems to be in pretty good shape. What are you taking away?
Yeah, the consumer is holding in there. A bit of a surprise. You know, we were on the Target call this morning, or Target, as you said, and their sales were not as strong as you would like. They lowered guidance for the year, but they're executing on so many engines that and their margin expanded about 300 basis points. You know, we see the consumer holding in there. I was looking at data. We look at we survey the consumer on a weekly basis. Where are they shopping non-food? We saw over the course of the last 5 weeks, Walmart gained 13.2 percentage points in where consumers are shopping.
Wow.
Target was really flat. So Walmart incredibly well. TJ Maxx up 2.6 percentage points. Dollar goods, Dollar General rather, the dollar stores, up 6 percentage points. At the same time, Macy's, Kohl's, and Amazon down 2 and 3 percentage points. So, I mean, this talks to me that consumers are looking for value. They're looking for stores, physical stores, and services in physical stores. One of the interesting things on the Target call is that what consumers really want is the ability to drive up and do curbside returns, which can be done now in on average 3 minutes. And guess what? Bring me a latte at the same time. And they're rolling that. They've tested. They're rolling that out nationwide. They said on the call that by October, you would be able to get your Halloween latte with your Target pickup or return purchases curbside.
Pumpkin spice.
Yes, yeah, the pumpkin spice.
Omni-channel.
One thing that Brian Cornell said, and it's really bears repeating, is he said this is the 4th year in a row that business has been different than anything we've ever known before. And Target today is a different company. And I think that you could say the same is true for Walmart. I mean, Target and Walmart are different companies coming out of what we've just gone through. I'm not giving you the chance to ask me any questions because it's like so much of what I've heard is so exciting. Supply chains are like almost back to normal. What Target said was they've improved their supply chain 30 days and it's almost where they were pre-pandemic. That means that retailers will be able to more quickly fill, more quickly order what consumers are asking for and get it to the store. And because of what these companies are doing internally in terms of their efficiencies, logistics, operations, it's less expensive and quicker for them to get products from the DCs to the store. So, there's a lot of things.
So more margin, basically.
Yeah. More margin there, so that even if there's less sales right now at a Target, they're able to wring out more profits, and that goes to their margin expanding from like 1.2 to 4.8.
How much are sales going to pick up, Marie, as we go into the back to school season? Previously it was the same every year or close to it, but we had a couple of pandemic years in which the stuff you needed was maybe a little bit different, and I guess we're going to get back to a normal back-to-school season this year. What do you think?
Well, pre-pandemic, normal back to school always was being pushed, like it began earlier and slowly, like very dribs and drabs in June and July. And then like the August kind of got pushed into September because when a lot of kids don't want to buy apparel until they see what their friends are wearing. So what Brian Cornell said on the call was that he saw back to school really moving into extending throughout September. And that's something that we would agree with. It has begun already, but it's just the beginning.
All right, so that's kind of the real world, the Walmarts, the Targets of the world, the TJ Maxx. How about luxury? What's happening in the world of luxury these days, Marie?
Yeah, so we're seeing like acquisitions, LVMH carrying. Just last week we saw Tapestry by Capri. So this is really interesting. Capri reported their numbers last week, not really strong, but under the new umbrella of a Tapestry, we think that there's synergies to be had. It is really the formation of an American luxury house of houses, right? Most of the brands are really aspirational with accessible price points. But there are two brands within the portfolio which Tapestry acquired, Jimmy Choo and Versace, which are higher priced designer labels which have the possibility to become what, a European luxury house. And we'll see how that goes. American luxury is different than European luxury, and European luxury is really where luxury started. The Kerings and the LVMHs and they have American LVMH purchased Tiffany. Tiffany is a good example of American luxury, as is Coach. It's like these are very democratic, aspirational brands that are inclusive, and they have accessible price points. They're known for great quality. They also are known for great inclusivity and friendliness, where for many years the luxury houses were kind of snooty. Never like that at Tiffany. Never like that at Coach. They are amazing. And that's.
All right, we're going to have to leave it there, Marie, just because of time, but appreciate getting your thoughts as always. Marie Driscoll, she's a retail analyst at Core Site Research. Again, we got some numbers from Target this morning. The street kind of liked the margin story. Walmart tomorrow before the close. That'll give us a great read on the consumer. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Good morning. After failing to win regulatory approval in time, Intel says it's walking away from trying to acquire Tower Semiconductor for $5.4 billion. Bloomberg's Debbie Wu has more on what this means for Intel's future.
Due to the failure to acquire Tower Semiconductor, this could become more challenging for Intel to get into the market. So we'll have to wait and see whether Intel comes up with a new strategy to better compete with TSMC and Samsung on the foundry front.
Now, shares of Intel are down about 2.5%. Shares of Hawaiian Electric, however, they are starting to climb after taking a big hit. They're up about 11% right now as the company faces questions about its equipment being linked to the Maui wildfires. Bloomberg's Katie Greifeld has more on the downfall.
Hawaiian Electric has shed $1.8 billion in market cap just over the past week. Shares closed at their lowest level since 2009 yesterday. And of course, analysts have been cutting their price targets on Hawaiian Electric in a hurry. And the S&P also downgraded Hawaiian Electric to junk status.
Now, we're also getting more insight on the damage from the wildfires. They are estimated to cost insurers about $3.2 billion. That's according to risk modeling firm Karen and Clark Company. And Amazon merchants who ship products themselves will soon have to pay a fee. Another one. Yes, third-party sellers who don't use a company's services, they will start paying a 2% fee on each sale in October on top of the commissions that they already pay. Now, this is the government set to file an antitrust lawsuit against the e-commerce giant. Shares of Amazon right now down 1.5%. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney here in the Bloomberg Interactive Brokers studio looking at these markets. S&P 500 trading off about 0.25%. The Dow Jones Industrial is pretty much unchanged. NASDAQ is kind of feeling the pain here, off 0.6%. The VIX, about 16 right here, below 20, we'll note. Yield space, a couple bips higher on the 10-year Treasury, 4.23%. The 2 years at 4.95%. WTI crude oil, it's off by 1.4%. We're now below $80 a barrel, $79.88. We'll note that. Right now, let's head down to Washington, D.C. We'll get world and national news. Amy Morris.
Thanks, Paul. Searchers continue to comb through the ashes of the town of Lahaina on the Hawaiian island of Maui, hoping to identify victims of the deadly wildfires. The death toll there has now reached 106, with the search having only covered a third of the town. Relatives of the missing are providing DNA samples to help with the identification of remains. Well, after promising a trip soon, the White House today says President Biden will be traveling to Hawaii next week to survey the wildfire damage. Bloomberg's Amy Morris has details from Washington.
The President and First Lady will travel to Maui on Monday, August 21st, to meet with first responders, survivors, and local officials after those deadly wildfires, following criticism of the White House response to the disaster. The White House has been facing pressure over whether Biden would travel to Maui since this weekend, when he was asked about the rising death toll while he was on vacation at the beach in Delaware. The president had said that he did not want a presidential visit to impede the recovery efforts. In Washington, I'm Amy Morris, Bloomberg Radio.
Well, the U.S. is not alone in dealing with the severe summer heat wave. As Bloomberg's Ellie Harmsworth reports from London, Europe is also dealing with weather extremes.
You'll see in areas that are not only warnings for heat, but there'll be warnings for extreme rain and extreme, flooding caused by rain.
Harmsworth says residents in southern and central France are being told to stay indoors, with temperatures in the next few days expected to be as high as 16 degrees above normal. Well, there's a flicker of good news on whether there will be a government shutdown in September. Today, Senate Majority Leader Chuck Schumer told MSNBC that he had spoken with House Speaker Kevin McCarthy just a few weeks ago, and they agreed that Congress should do a short-term measure. While talks on government funding continue, Schumer says he sees that as a good sign. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Matt.
You are Nancy Lyons. Thank you so much, Nancy. I misidentified you earlier. Apologize for that. Nancy Lyons down in Washington, D.C., giving us the news there. Real estate, New York City. It's expensive for everyone. And according to Dow Jones, the Wall Street Journal, an apartment on Billionaires Row in New York City is selling for around $80 million, making it one of the priciest deals in the city so far this year. That's according to two people familiar with the situation. The apartment is located at the condominium 220 Central Park South, which, by the way, we can see here right across the street from the Bloomberg HQ. The seller was a company tied to a New York-based Nima Capital, an investment firm headed by entrepreneur Suna Saeed, according to property records and people familiar with the situation. Saeed couldn't immediately be reached for comment. The entity paid about $65.59 million for the Central Park-facing apartment in 2020, records show. The buyer could not be determined. The unit spans close to 8,000 square feet, according to the building's offering plan. The deal is the latest in a string of major resales at 2020 Central Park South, which is widely regarded as the city's most prestigious condominium building. Residents of the building, designed by Robert A.M. Stern Architects, have access to private dining rooms, an athletic club, a juice bar, a basketball court, and a golf simulator. Last year, billionaire investor Daniel Ock sold a penthouse at the building for about $190 million, roughly double what he paid just 2 years prior. The seller is in this deal, could not be identified. Saeed said her husband, Scott Maslin, recently purchased a roughly $45 million Silicon Valley compound from former JetBlue chairman Joel Peterson, the Wall Street Journal reported. Maslin is a founder of real estate investment firm Wood Glen Investments. So how about that? Real estate moving in New York. Right now, Balance of Power with Joe Matthew. That starts right now.
0.4% at 44.25. Take a look at the 10-year yield coming up a little bit right now, 423.86. So we've been hovering around 420, just below that for most of the morning, and it has now rallied higher. I'm going to give you some comments from former Treasury Secretary Larry Summers. He spoke with David Weston about a much higher rate over the next 10 years on average. The Bloomberg U.S. Dollar Index continues to gain ground, right now trading at 1240. It's seen a lot of strength over the past 4 weeks or so. As these yields get higher, they're more attractive to foreign investors who then need to buy dollars to access that. And then crude is very interesting trade today because we actually had inventories come in a little bit light, and nonetheless we see NYMEX crude falling below $80 a barrel. So West Texas Intermediate going for $79.84. I want to talk though about the housing sector first off today. 30-year mortgage rates have now topped 7%. That's a threshold that will impact affordability, sales, and refinancing activity. Of course, here's Bloomberg's Reed Pickard to explain. Reed, what do we know about what a 7% mortgage is going to do to this housing market, which already seems like it's in a deadlock since homeowners don't want to give up the cheaper mortgages that they have?
That's exactly right. So today we got data that showed that the 30-year contract rate on a mortgage went up to 7.16%, which is matching the highest now since 2001. And so what we're expecting is kind of a two-part situation. One is that when you see higher mortgage rates, that restricts demand. On the flip side, though, it also leads people to not want to list their homes. And the reason that we've had a lot of headwinds for the housing sector more generally is because people look around and they know that they have their 2-3% mortgage rate and they don't want to trade that in. And so that lack of inventory has really been what's been keeping existing home sales down. And it's part of the reason that we've seen home prices start to pick back up again. But what's interesting is how this will impact builders, because we saw yesterday that home builder sentiment declined for the first time this year, in part due to this pickup in mortgage rates that we're seeing. And so it'll be interesting to see if we continue to have builders, really go out there and continue to build to try to meet this demand when inventories in the new home sales, in the new housing market is already pretty elevated.
You can imagine that if people aren't going to give up existing homes, new inventory is the only way to tackle the problem. On the other hand, as you said, sentiment fell, and we saw building permits come in pretty light. We were expecting a jump of 1.5%. Building permits this morning came in up only 0.1%. At the same time, housing starts month over month were up 3.9%. We were only looking for 1.1%. How do you sort of rectify that diverging data?
So it's important to get under the headline numbers today, especially in that housing starts data. And when you look under that permits data, really what you actually saw is in the single family housing, you saw permits rise by the most in over a year. So it was really that multifamily housing component that was dragging down that number and led to that really tepid gain in permits. So when you look at the picture, at least what we got today, is that there's still this pipeline that builders are looking to keep building. So it'll be interesting to see if that continues as we look later into the year. I mean, housing has been a drag on the U.S. economy for a long time now, but its turnaround is something that a lot of economists have been looking to as a reason that the U.S. may avoid a recession, is this rebound. So it'll be interesting to see whether this new headwind of higher mortgage rates, really hits housing back down, or whether it can really hold and keep its footing.
All right, Reed, thanks so much for joining us. Reed Pickard there talking to us about the housing picture out of Washington, D.C. Meanwhile, former U.S. Treasury Secretary Larry Summers says the recent run-up in 10-year yields may have further to go. Here's what he told David Weston for Wall Street Week.
If you take 2.5 and for inflation, you take 1.5, which isn't especially aggressive for real rates, and you take 75 basis points, which is lower than history, for term premiums, you're looking at 475 on the 10-year, and it obviously could end up being higher than that. So nobody knows, but it seems to me we're in a very different era than the era we were in the aftermath of the financial crisis.
Here with more is David Weston, the host of Wall Street Week. And it's interesting, Larry Summers coming out really bearish on treasuries and even topping yield forecasts from the Bills, Dudley and Gross.
Yeah, exactly. One of the things about working with Larry is he always goes to the math. And you heard him there lay it out. 2.5% for inflation doesn't seem too outlandish. 1.5% is historically low, if anything, for real interest rates. Then there's term premium, and that all adds up to 4.75. And he did say there, Matt, it could go higher. For example, he thinks we're going to have to be spending more on defense given geopolitical situations, borrowing more, and also our borrowing costs are going up, and we're going to have to pay interest on all that debt.
So what else did he have to say about the effects of this? Because we just talked with Reed about mortgage rates. You know, typically mortgage rates are about 2% above the 10-year yield. So that's right where we are now.
Yeah, exactly. And it doesn't say anything happy about people who are going out and getting mortgages. It says something happy for people who already have mortgages at 2 or 3%. They've got a pretty great asset there that they can sit on. And that may be part of the reason why some people say, like Rick Reeder last week said, maybe the economy is a little less sensitive to interest rate changes right now because a lot of people have longer-term debt that they're enjoying. And also there's a shift to the services. But you have to anticipate the possibility we're going to have a tougher time. But you know this, Matt. We were in an artificial period. You don't have negative real rates for an extended period of time where money was free. It's not going to be free anymore.
Yeah, absolutely. And it does, I think, show some optimism on his part in terms of the inflation outlook, right? He does think that we'll be at 2.5% over a prolonged period.
Yeah, he thinks we're going to get there. The question is how you get there. It's also interesting. One of the things he said to us was he no longer thinks a recession is likely this year. Before he was saying that's more than 50% likely. He doesn't think that's true. It might well happen in 2024. But one of the interesting points he makes is if you don't have the recession, then as a practical matter, the Fed is not going to be cutting rates. So you shouldn't be expecting cutting rates if there's not a recession. You can't have it both ways.
All right, very interesting interview. David Weston, host of Wall Street Week. You can catch that program at 6 p.m. New York time this Friday right here on Bloomberg Television. Up next, American Securities CEO Michael Fish on the state of private equity today. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
This is Bloomberg Markets. I'm Matt Miller. Markets are fluctuating today ahead of the Fed minutes. They come out at 2 p.m., and then we'll get a better sense of why officials are showing optimism for a soft landing. That said, interest rates remain high, and that is impacting private markets. Let's get a read on the private equity space right now with Michael Fish. He is the CEO of American Securities, as well as Bloomberg's Shonali Bassick. She's our Wall Street reporter. She joins us here on set as well. Michael, thanks so much for coming to the program. I wonder what you think as we talk so much about higher rates. I just did a story on mortgage rates over 7%. We just heard from Larry Summers, who thinks the 10-year will average 4.75% over the next decade. How does that affect your business?
It affects it a lot. It's very important to plan for rates. It's not catastrophic for private equity. Deal flow is down 40% from last year, 60% roughly from the year before, but that means still half of deals are still getting done. But rates matter. Again, what you plan for and what you expect. 40 years ago, people borrowed at prime plus 2.5, so senior debt was 14.5%. And the private equity business was exploding then, and it's doing well now. But if you bought companies planning for lower rates and didn't hedge it, that's a problem. And the cost of your inventories, which are up because of supply chain problems and inflation, is another problem. And then if projected earnings don't come in, management has to be nimble.
Curious about the inflation story and how that is reading through your portfolio still. What are the sticky problems that you're seeing lasting on?
Well, we try to focus on the market share leader, and the market share leader almost always gets at least its fair share of scarce products, and scarcity of products leads to inflation, so the market share leaders tend to do well. The smaller players often can't have products, and so their sales are down or can't pass along products, and so, as in many situations, being bigger here is good.
What about the idea of exits here? On one hand, interest rates also impacts the cost of financing, which has been impacting deals. But then the other thing about this is it's been hard to sell into public markets. The IPO market has been very closed. Sales have started to come back slowly. What does it look like out there?
Well, it's the same thing. It's the reverse of the New Deal market. So sales are still possible. Volume is roughly half of what it was. The sellers and the sources are less IPO, but more taking public companies private, buying corporate carve-outs, corporate divestitures. That's a very active and increasing percentage of our deal flow.
So I'm interested to hear about your portfolio companies, because you say you focus on the market leaders. What are some examples of the portfolio companies that are doing the best for you?
Well, 60% of our investments are in industrial companies. Industrials are often misunderstood. They have grown for 20 years faster than the U.S. GDP. They're still growing, and many of them are non-cyclical. And so if you're in the used truck parts business, that's a really good place. If you're making orthopedic shoulders, that's a really good place to be, unrelated to GDP cycles. There's a whole bunch of manufacturing companies that are doing real well. If you were in some consumer businesses with aggressive forecasts, that's been more challenging over the last 6 months.
Let's talk more about that, because you have some very interesting businesses in consumer retail, restaurants, Potbelly, Conair. How do they fare through this cycle, and what concerns of a bigger consumer slowdown do you have ahead?
Well, we try to capitalize a company to build revenues in good times and market share in down times, and so that's certainly the case. Conair is an example of a company which is building market share now and doing just fine on revenues. Hopefully it dots all of your kitchens with Cuisinart products. And there are other companies. Belfour is in the disaster recovery space, so it is uncorrelated, like orthopedic products, to cycles. It's really correlated to rain and
improving. I mean, we see so many disasters more. I just heard Matthew Palazzola, our Bloomberg intelligence analyst, say that wildfires have gone up 400% this century. And of course, we see it in Hawaii, we see it in Canada. Does that company then get more business as, I guess, climate change increases natural disasters?
Well, Hawaii and the wildfires, and we had them in New York with the air, are very, very sad. Certainly, my heart goes out to people in Maui. Belfour is anti-fragile. It's more fragile to water, so hurricanes, big rainstorms lead people. You've got a leak, you've got to fix it, or you're going to lose your house, and so it always gets fixed. And Belfour is there with men and women to solve a problem when a hurricane comes.
Where else are you looking at areas to deploy fresh capital? Are there certain industries or themes you're looking to capitalize on as the economy takes a new turn?
Sure. We are always looking for industries that may have a tailwind, and in up and down times, there's always something growing. We are now the largest solar EPC in the country. There's an exploding demand for green energy, clean energy, and solar. And so that's just one example. We're always looking at water because water is a great place to be. And there's a lot of companies that help process more and more food and make food production more efficient because there's a growing number of people, obviously, and a food shortage exacerbated by some of these climate issues, Matt, that you were talking about.
You know, I was living in Berlin for the last 6 years. It was wonderful. And I would go to the Super Return Conference every year, at which I would be quoted an ever-increasing number for the dry powder out there, right? It was 1.7 trillion, then it was 2, then it was 2.7 trillion. Is there really that much cash or cash availability in private equity?
Yes. Right now, according to one consulting firm recently, there's $3.7 trillion of dry powder. About $1 trillion of that is just private equity or so-called buyouts. The rest is venture, infrastructure, and other things. And that's a big number, but what I always think is more important is what percentage of the ecosystem that is. And so one way to express that is how many years of investment at the current pacing is that? And typically it's been between 2 and 5 years of pacing in dry powder, and now that's about 3.4 years. So it's kind of right where it's always been. It grows because the industry keeps growing.
But is one of the problems here that there is too much money chasing too few deals? Structurally, you have other issues like rates we've been talking about, but that sheer amount of money seems like it could be a problem ahead.
One could think that. The first time I heard TMMC TFD was 1987.
What does that mean?
Too much money chasing too few deals. Now it just depends on your space. In the middle market, which we play in, there's actually enormous growth and very little capital. In some places, there's tons of money and smaller numbers of deals. It just depends. And back to your point about interest rates, in the very large deal space, the lack of a syndicated debt financing market for the last 12 to 18 months constrains the ability for a lot of those large deals, not so in the middle market space where private credit is readily available.
You, at the firm you founded, you've mentioned the portfolio companies that you're in, industrials and, Cuisinart and truck parts, Belford, Potbelly. Shonali mentioned Potbelly.
Chicago girl, what are you going to do?
But not a lot of tech. Have you been there and you're leaving? Are you pivoted away from tech, or did we just not hear about those companies?
It's a great space, and I know lots of smart people pursuing that space. We've been focused on industrial businesses for 30 years. It's roughly 60% of what we've invested in. We also do services, consumer, and some healthcare services. So we're bringing tech, because tech is everywhere. It's in all of our companies. It's all around us here. We're bringing tech to these old economy companies, but we are not investing in tech per se.
Well, what about AI here? Do you think that jobs are going to be impacted by tech, especially evolving technology?
There's almost no question about it. There's a large investment bank which came out with a study saying 25% of jobs are going to be displaced through AI. And on the one hand, that can be very, very problematic if it's your job, and how we retrain those people is going to be a big issue. The bulls would say that leads to more efficiency, higher productivity. We're seeing it across all of our companies now. A lot of AI projects going on to read documents, to process consumer issues faster, to locate new restaurants, if it was a Potbelly, which is a former investment, or new service centers for truck parts. AI is everywhere, and everyone's figuring out how to use it and how to adopt it.
Great having you here with us. Hope we get some more time with you in the future. Michael Fish is the CEO and founder of American Securities, and our star Wall Street reporter, Shonali Basak. Thank you so much, as always. Still ahead, risks from high-potency marijuana have lawmakers rethinking regulation. We'll talk about dabs next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
This is Bloomberg Markets. I'm Matt Miller. Today's Big Take looks at the recreational marijuana industry, which is pouring money into products with high THC levels, of course. Early to legalize states are possibly rethinking their laws because of extremely high THC level products that are causing health problems for those who use them. Bloomberg's Tiffany Carey wrote the story and joins me now. So Tiffany, it's important to point out that not everybody using weed is doing dabs, right? These incredibly concentrated THC gooey products that are practically smoked out of a crack pipe. But those who are have had issues.
That's right. There's a huge range of marijuana products right now, from old-fashioned raw flower that people roll into joints, edibles, vapes. But I think what we've seen is with the vapes and the concentrates, which are these products like dabs, wax, and shatter, the THC is not only, 60% and up, but can be sometimes 90% and up. And that's where we're starting to see people complain about these health issues.
Is there any regulation inside, saying like, okay, you can sell flour, you can sell gummies or edibles, but we have a problem with, shatter or butter or dabs?
We've seen some states debate this. Vermont is one state where it's become an issue. I really focused for this story on Colorado and Washington because they were the earliest states to really start recreational sales, and they're saying, look, we're seeing a lot more of these products. We're seeing them being sold out the back door, sometimes to kids, and they're trying to come up with regulations, but they're seeing this pushback from the industry that's saying, look, maybe medical patients need these products. You can't just go and cap THC. That would wipe out, a huge swath of the marijuana industry's products.
But there are some parallels with the alcohol industry, right? I mean, you can buy, beers and wines are between like 4 and 14% alcohol, and then you've got hard liquor that's 40, maybe 50%, and then Everclear, which in a lot of states is illegal, right? Which is more like 95%. Why can't they do something like that?
Yeah, it's a really interesting analogy. I think there's also an interesting analogy in tobacco where we've seen, cigarettes have been sold for so long, then there was more of a controversy over vape, which had higher nicotine levels and accusations that maybe those higher nicotine levels were used to addict people. And only now, a century into people smoking, are we talking about, or the regulators are talking about, maybe actually putting nicotine caps in tobacco. So I think with cannabis, the science is just so much younger than it is with either alcohol or tobacco. It's really, we're waiting to figure out more.
So I recently saw a story that Ohio is putting recreational use on the ballot, or they're trying to get it on the ballot. And there's some speculation that may sway Sherrod Brown, the head of the Senate Banking Committee, to push safe banking. Have you heard anything about the Safe Banking Act and any progress there? Because that's one of the big problems for this burgeoning industry.
It has been, and it has just continued to fail to get traction. It's hard to say when there's been so much hope for so long and it keeps getting pushed off what the prospects really are.
But problems like this, people who are using incredibly high concentrates and doing damage to their health, don't really help.
I don't think it helps the industry, no. I mean, I was surprised to find, as I reported this, that really more than a third of the marijuana industry's products seem to fall into this category now. So you have a cannabis industry that's very dependent on these products that there's uncertain regulatory prospects and health concerns about.
Tiffany, great having you on the program. Thanks so much for joining us. Tiffany Carey there talking to us about weed. Check out the Big Take story on the Bloomberg. Type NI Big Take. Go or check it out on the website at Bloomberg.com. Coming up, venture capitalist John Ruffalo on startup funding in the U.S. tech space. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
This is Bloomberg.
I'm John Ehrlichman. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on the markets right now. We do have the S&P off about 0.4%. Slightly lighter volume because, of course, we're waiting for the Fed minutes. They come out at 2 o'clock, so just about 30 minutes from now. You have the 10-year yield rising almost 4 basis points up to 424.84 right now. So it's really picked up in the afternoon. The Bloomberg Dollar Index is also picked up right now, trading at 1240, 1241. And oil, interestingly, is down $1.30 a barrel at $79.69, even after inventories came in a little bit light, John.
Pretty dramatic move for oil over the last week after that move towards 85, Matt. And then sector-wise, we're not seeing any real standouts today, although the insurance sector has been on the move. We had those underwriting number updates from Progressive. That stock's up about 8% right now. We're going to be talking this half hour about the retail story, the target numbers, but also TJ Maxx in the spotlight with some fairly broad sales gains, and that stock's up about 4%. And then we've been watching Coinbase's stock stock today, just staying with the technology theme, Matt, where we saw that approval on the crypto futures in the U.S. Stocks down right now. One stock that is more, well, flat basically at this point. One stock that is more notably weaker on the session is Tencent, as the China weakness is evident in their latest quarterly results, but also some of the softness in the technology sector in China.
Let's stick with the technology sector, but bring it back here to North America. Tech stocks have struggled recently. The NASDAQ 100 here in New York rallied a whopping 44% through July, has had a steeper drop this month than the S&P and the Dow. Our next guest is one of Canada's best-known tech investors. He previously founded the venture arm of pension giant OMERS, leading early investments in companies like Shopify. John Ruffalo is the founder and managing partner of Mavericks Private Equity. He joins us now from Toronto. John, thanks very much for your time. I got to ask first about rates. You know, we just saw the mortgage rates here go up over 7% officially, and Larry Summers is going to be on David Weston's program, Wall Street Week. He said he thinks the 10-year will average 4.75 over the next decade. How are rates like this affecting your business?
Well, I actually think the rates are actually coming back to the long-term mean, and it's actually making technology businesses ultimately more sustainable. So much over the last decade, they were fueled by excessively cheap rates, and capital was funding businesses that perhaps should not have been sustainable businesses in the first place. So I think that if rates kind of stay like this and not really move much more, or maybe drop a little bit, but I don't think this is a cataclysmic situation for the tech sector.
One of the problems that we saw earlier this year as a result of rising rates, to some extent, you could also say as a result of bad management as well, SVB and a few other banks failed, but specifically SVB, so important to the venture capital world. How did you get through that, and how do your portfolio companies deal with it?
Well, in Canada, they really weren't a significant player. They were about 10 years ago, but the Canadian banks started taking away their market share. So although they were a very good and reputable player, their real influence was that they were quite aggressive in their pricing, and it kept the Canadian banks, honest in terms of the structures for the technology companies. But it really wasn't that big of an issue. Certainly from a deposit perspective, very, very little impact. And then once it was insured, obviously no impact. But, it's now been taken over by another bank, and it's just created, again, healthy competition in Canada.
And I think what's interesting, John, we go from this year of challenge 2022, the uncertainty with Silicon Valley Bank, to all this excitement around artificial intelligence. And we spoke with you at the Collision Tech Conference in Toronto not that long ago, where that AI hype was in front of everybody. But as an investor, how are you looking at the AI story right now?
Well, I'm looking at it the same way that I did before, but I think the rest of the market is starting to calm down a little bit, and to oversimplify the two macro areas of investment. There was the investments at the infrastructure layer, or the large language model layer, and OpenAI certainly has taken the public by storm. But that area of investment, my view is that there's only going to be a few very, very large players in the world. And by the way, you're seeing it now. There's a lot of questionable activity also going on there in terms of where they're grabbing all of their data from. And I also believe there's going to be so few players that are going to make money ultimately by being at that infrastructure layer. It's just like a big utility. The interesting area for me is at the application layer. This is the layer where they're actually doing things for, particularly for companies, and making their businesses more effective. This is what's going to really change the world. And at that level, at the application layer, there's going to be hundreds and thousands of great companies there. And that's where I think you're going to see venture dollars really start to focus in on.
Then there's a broad theme of investors being able to more broadly play in this sandbox, John. I mean, we've seen all the money flow into the big AI stocks, the publicly traded big players, but there has been an IPO drought for roughly a year and a half within the tech sector. What's your outlook on that front?
Well, I think that we're still in this infrastructure layer of investment. So let me give you a concrete example. In the public markets, you have NVIDIA. That's just gotten, their stock price has gotten through the moon because right now, where is so much of this money going to at the large language model layer? It's to buy chipsets. And you're seeing the NVIDIA stock shoot up. But there's going to be a point when that calms down. And you're going to see, I think, incredible activity and a lot of creative destruction where a lot of businesses are going to finally say, wow, I could really embed AI into my business. And, the negative side is that could mean a lot of layoffs or a lot of transition of people. But I think this is the exciting area. And this is the area that I would say people need to watch out for, especially as the United States has determined that this is a strategic and a national security issue. And as they pull away from their investment, particularly in China, you're going to see more and more companies stateside that are going to be investing in this space.
Does that have any effect? President Biden signing that executive order last week. We have a story that Congress would like more oversight into investments by big, asset managers like BlackRock, for example. But what about, your portfolio companies or companies just getting a foothold in these markets? Do they have to be really worried about their connections, possibly investments in or any kind of presence in China?
I would say that if you're in sensitive industries, you might have to. So if you're in developing infrastructure layer, AI, quantum, certain cybersecurity companies, I think the answer is going to be yes. And, what you're going to hope for is there's going to be a trade-off. If, for example, the United States was, let's just talk about the U.S. government, was procuring goods in these sensitive sectors from China, it was going to need to be replaced. So that creates an opportunity. The real question is, will the decrease in the inbound ordering of goods from China be offset by the activities in the United States or in its allies? And this is, right now there's a shortage of manufacturing capacity, but like I've always said, never bet against the United States to change that equation very, very quickly.
By the way, you mentioned creative destruction. We were just talking with Michael Fish of American Securities, their private equity, and he was talking about the fact that AI is going to definitely displace a lot of people from jobs. Of course, it will create jobs as well, right? We've seen that from every kind of paradigm shift. The internet put people out of jobs, but putting a lot more people in jobs. Where do you see, John, job creation due to AI?
Well, I would say that I probably fall a little bit more on the pessimistic side. And the reason is you're absolutely right. Since the Industrial Revolution, this creative destruction has always occurred. But there's two differences now that make it more challenging. The rate of change of the displacement has never been this fast. Before, it used to take generations. Jesus, now we're talking, it's taking 6 months for displacements to occur. And that is not necessarily enough time to do some, retraining of people. And then number two, it was largely on human labor, physical human labor that was being displaced. Now we're getting into brain power. And I think a lot of the white collar workers who have gone to school, who have been educated in certain areas, really didn't expect this. So in the long term, do I think that the new jobs, particularly understanding data, understanding, different techniques on how to attract customers and all those areas? Absolutely. Will there be a time lag? I would say there will have to be. And what's going to have to likely happen is that the governments are likely going to have to use taxation dollars or social programs to perhaps bridge that displacement.
It paints a picture of a very different world, John, and it's great to get your perspective. We'll keep the conversation going. Thanks very much for joining us, John Ruffalo of Mavericks Private Equity, on the tech landscape and the AI boom. We're going to talk about earnings in the spotlight today in the retail sector. Target out with its quarterly results. Corey Tarlow will join us from Jefferies with his take on what's happening in the retail sector next. This is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our stock of the hour. And we're watching the retail sector and shares of Target today. They're off their highs, but still up in the session. The retailer's profits surging in the latest quarter. Inventory improvements and some cost controls. Matt, the better profit margins we saw ultimately lessening the sting from the fact that this was the first sales decline for Target in 4 years.
Yeah, to me, it's still kind of puzzling that investors take so many positives out of of an earnings report with an outlook that's so bad, right? Corey Tarlow is going to join us to tell us what's happening there. He's Jefferies Equity Research Vice President. He has a buy rating on Target with a $175 price target. And I know maybe it was expected that Target would bring its forecast down a little bit. But still, like, who cares about the quarter that happened? We only care about the quarter that's coming, right?
Yeah. So I'd say that there are probably 3 key points that I would make. The first would be on sales, the second would be on margin, and the third would be on the outlook. On sales, we saw comps decline about 5%. The street had expected there to be about a 3.7% comp decline, so it was worse than expected. But the kicker was that margins were better. So to my second point on margins, the gross margin came in at 27%. And the historical average is actually close to, if you go back over the last 10 years, about 29 to 30%. I know you like to look at stocks on a more longer-term basis. So there is definitely opportunity to get more in line with what we've seen historically. And then just on the outlook was lowered by about 10%, and it's mainly due to a consumer that's been maybe overall a little bit resilient, but we're starting to see some signs of a little bit of hesitancy. And then on the back of what we are likely to see is a pullback due to student loans resuming, some caution on behalf of Target management.
And Corey, once we're through this busy retail earnings season, do you think outside of the reality of a changing consumer base, we'll have some strong takeaways on the haves and the have-nots? Who's getting the lion's share of that spending money right now?
Certainly. So I think that, as I alluded to, the consumer, again, has been a little bit more resilient than expected. But we are seeing under the surface some indications of the consumer becoming incrementally more stretched, and that we're starting to see consumers shifting from wants into needs, and then further beyond that, shifting within those needs categories further into private label away from brands. And now you're starting to see credit metrics spike as a percentage of tender, which is a further indication that the consumer is becoming even more stretched. And so as we think about the retailers that, again, are the haves and the have-nots, certainly one that comes to mind, which reports tomorrow, is Walmart as a have. The company, I think, in stark contrast to Target, is likely to post fairly robust second quarter results on the back of consumer trade down that's likely to lead to outsized comp sales. And then you also have a business in the Walmart e-commerce business that has been growing at a very healthy rate. And what we did, rather uniquely, was we took a look at app usage during a key selling period that everybody knows, Amazon Prime Week, which is now also Walmart Plus Week. And during that Walmart Plus Week, we saw Walmart app usage surge nearly 30%. And that business is growing at a rate of around 30%. So we expect that to help to continue to buoy results ahead when we hear from Walmart tomorrow.
I do like to look at stocks over a longer time period, typically 5 years, just because the comp function defaults to that on the Bloomberg. And I thought it was interesting when I looked at Target versus Walmart today, because Target had such a great pandemic. They just shot up and have now come crashing back down. Walmart was chugging along, and it looks like that stock is actually about to overtake Target over 5 years. They're both up about 75%. Also, if you put Amazon up there, they've only returned 44 or 45%. They're doing worse than both Walmart and Target over a 5-year period, but none of them compares to Costco, which is up 170%. You talk about trading down and private labels, I think about Kirkland right away. This is a company that's doing a lot better than the others. Is it going to be a beneficiary?
We think so. The one remarkable thing about Costco is that the membership metrics have continued to be incredibly robust. And although the business is a $225 billion enterprise, the profit margins are relatively slim. And what makes up that profit margin is actually predominantly just membership dollars. And on the back of Sam's Club raising its membership fee from $45 to $50 for the base, we think that now might be a good time for Costco at some point on the horizon to raise its membership fee and potentially even provide another boost to profitability. So clearly, as in an environment where consumers are prioritizing needs over wants, you have a membership model that drives predictability in sales and profitability, and a potential catalyst on the horizon. It's definitely a stock that we like. And to your point on Kirkland, that's about 1/3 of the overall business and growing for Costco, and also helps to support slightly better margins than some of the name brand products.
Great insight, Corey. Thanks so much. Corey Tarlow, Jefferies Equity Research Vice President, and we'll keep an eye on those Walmart numbers tomorrow as well. Coming up, Tesla continues price cuts worldwide, and we'll have more on those decisions and the impact on the bottom line next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup.
This is a 3 as the economic picture does.
The OK is getting ready to make a decision.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Markets. I'm Matt Miller with John Ehrlichman. For 3 days, Tesla has announced price cuts to its cars around the world. Bloomberg's Ed Ludlow covers EVs for us, and he joins us now to talk more about this. So, Ed, really, it's mainly China, right? And they made slight price cuts on Monday, and then came out yesterday with much bigger price cuts on the higher-end models.
Yeah, and it's Tesla and Elon Musk being consistent. So Monday, there was a $1,900 trim to the high-spec Model Ys in the Chinese market. Tuesday, a new entry-level price for the base Model S and Model X in the US, and then overnight a $10,000 cut to Model S and Model X in China. And you go back to July 19th in the earnings call, Elon Musk telegraphed that this could happen. You know, they've used the lever of price cuts to open new pockets of demand really well. It's just so interesting, the timing in the context of China's economy right now. But for me, like, this is a data story, and Tesla being able to real-time judge demand of consumers around the world.
And I guess, Ed, what does that mean for the rest of the industry, which obviously has to keep pace with the likes of Tesla?
Yeah, I mean, what Elon Musk outlined is exactly that, like data. They feel dialed in on understanding what a consumer is willing to do. You know, buying a car is a big consideration in any economy. The concern from the market, and you look at shares under pressure, we're down for a 4th straight day on Tesla for the 2nd time this month, is that it widens out an EV price war. The reason China was surprising is that on July 6th, Tesla, along with the domestic players in China, agreed to a price stability pact, essentially. the wording of which stated quite clearly that it was non-binding. But Tesla really quickly changed direction and said, actually, you know what, we will cut prices. The concern is that this comes with US domestic automakers in Europe and in the other Chinese domestic makers as well, because it impacts bottom line. So if you're an investor, your priority is completely different from a consumer who sees that and goes, great, I can suddenly afford this EV.
And none of them really are that affordable. Ed, do we see any other price cuts across manufacturers other than Ford, which I know has cut prices in response to Tesla? You know, BMW, Mercedes, Audi, they all make still very expensive electric vehicles.
They do, you know, run with the Mercedes example. Remember that in China, the back end of last year, Mercedes made very deep cuts to premium models in that market. And, you know, I kept asking them about how that would continue on. They've not used it in the sort of same cadence that Tesla has. So I would say that's the point of difference. Even with Ford, you know, theirs is a response, perhaps to Tesla in a domino effect, but they don't sort of do it with the regularity or the switch between raising prices and cutting that Tesla's done. Because remember, in 1H, Tesla did then go back and raise prices on certain models.
All right, Ed, great having you on the program as usual. Ed Ludlow, host of Bloomberg Technology, talking to us about the EV industry that he covers so well. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
It's noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
We said that Fed meeting back in late July here, a meeting that didn't necessarily surprise Katie Greifeld in terms of expectations, but of course there was a lot of drama behind the scenes. We know that based on some of the public comments that have been made by some of those FOMC members since.
Absolutely. A lot of unanimity among the officials on the voting front, but behind the scenes, it'll be interesting to take that look.
Minutes of those meetings now set to cross the Bloomberg wire at any minute. Let's get right to Kaylee Lyons down in Washington with the latest. Kaylee.
Well, Romaine, the minutes do show that despite the unanimous decision to hike rates by a quarter point in July, there was division among participants. The minutes say almost all participants judged it appropriate to raise the target range for Fed funds to 5.25% to 5.5%. But a, quote, couple of participants indicated that they favored leaving the rate unchanged, or they could have supported such a proposal. Now, importantly, as for the path forward, there is a signal in these minutes that the Fed is not done raising rates. The minutes say, quote, most participants continue to see significant upside risks to inflation, which could require further tightening of monetary policy. Now, participants observed that inflation still remained well above the 2% target and that they would need to see more data on inflation and further signs that aggregate supply and demand were moving into better balance to be confident that inflation pressures were abating. And in discussing the monetary and economic outlook, participants noted uncertainty remained elevated, agreed that policy decisions at future meetings should depend on the totality of incoming information and its implication for the balance of risks. The minutes note a, quote, number of participants judged that with the stance of monetary policy in restrictive territory, risks to the achievement of the committee's goals has become more two-sided. Now, Chairman Powell already told us in the news conference back in July that the Fed's staff has abandoned their view that a recession is coming by the end of this year. The minutes do show this and note staff observed indicators of spending and real activity had come in stronger than anticipated. The staff, though, does continue to expect real GDP growth in 2024 and 2025 would run below their estimate of potential output growth, leading to a small increase in the unemployment rate relative to its current level.
Kelly Lyons down in Washington, D.C., the co-host of Balance of Power, a read-through of the minutes from the most recent Fed meeting. The main headline here, inflation risk could require further tightening. Seth Carpenter joining us right now in studio. He's the chief global economist over at Morgan Stanley. And Seth, there's been a lot of talk since that meeting here about whether it was still appropriate for the Fed to continue raising rates further.
Yeah, I think that's the key question. That's going to continue to be the key question. I think from those minutes, there are inflation risks that could require, and so I think those two words are key. The risk, not the fact of, and the could, not the certainty of. And I think further that they needed to see more data as it comes in. And so what have we seen in the inflation data since that meeting? We have seen a continued trend down in inflation. The tricky part, of course, are those other services that Chair Powell keeps talking about, but goods inflation is negative. Housing inflation has been coming down. So I think it's going in the direction that's going to make them happy.
The key phrase in this report that jumped out at me, the minutes, is that their future moves should, quote, depend on the totality of the incoming information. And you just rattled off a bunch of economic data points, and we're going to get a lot more. But when you put those together in totality, is it really giving a clear picture?
I mean, it's difficult, and it is always a judgment call. What I think that phrase is trying to do is a few things, but primarily what they don't want to do is to tell people, here's one data indicator. If it's above this number, then we're going to hike rates, and if it's below this number, they don't want anyone to be on that kind of a hair trigger. They want to be able to take their time, soberly consider all of the data and ask themselves, is inflation trending down? Is there a reason to think that the decline in inflation that we've seen is only going to be temporary, or can we have confidence that in fact things are trending down? And that's what I think that language is supposed to convey.
And when we think about the data that we've gotten since the meeting, of course, at the meeting, what was striking to me was that it was another unanimous vote. And if you think about the commentary that we've gotten from Fed officials since then, we really haven't seen them. When do we start to see dissents? And from what we learned from these minutes, do you see that happening anytime soon?
So I think dissents are going to be an interesting part, because you can sort of lean in one direction or another, but still vote with the committee. But the fact that the minutes said that there were a couple of people, of participants, and not necessarily voters, who didn't think that there was a need to hike rates, I think that development will only continue from here. If we're really close to the peak, that means that some people are fine with where we are, others want to keep hiking. I think that's only going to continue over time, and at some point you'll just have to see the committee shift. Our house view at Morgan Stanley is that the Fed is in fact done at this point, but they're going to have to be convinced of that by the data coming in. So they'll get another set time in September to do their forecast of the economy. I think they're going to revise down their forecast for inflation for this year, and then they'll get to the November meeting, and by that point, if our forecast is right, the trend in the data will just be so clear that they won't see a need to hike again.
And Seth, it's sad to think that there's only 3 Fed meetings left this year, but we have half a meeting in Jackson Hole, if you want to count it that way. Are you expecting any revelations from Jerome Powell at Jackson Hole? Do you think he'll use that stage?
So he's definitely going to take the stage, and it is true that there are times in the past where Fed chairs have used Jackson Hole to make this bombshell announcement, which really shifts the market's understanding of things. I do not think that this is one of those times. I think he is likely to sound in tone a bit on the hawkish side to keep the optionality open in case they need to hike more. I think he's going to reiterate this view that they could stay higher for longer, and that's a theme that we've heard from Fed officials, from other officials at central banks. But what I don't think he's going to do is give any sort of commitment to a near-term policy move. I just think we're at an inflection point. I don't see how he can have enough confidence right now that he knows what they're going to do next.
It's interesting. There was some great reporting by one of our competitors about how few people are actually going to attend this, and of those who are attending Jackson Hole, meaning the Fed members, how few of them are going to actually speak publicly, or at least to the media, relative to what we saw in previous years. Does that sort of, I guess, color in this idea that there is maybe a little bit more uncertainty about where the Fed goes next?
I think that's very consistent with that idea, and there has to be uncertainty. Anytime you're at an inflection point, you could be going in any number of directions. We've already heard, so of the couple of members that didn't want to hike, your namesake, President Bostic of the Atlanta Fed has already said he thinks staying higher for longer instead of raising rates more. He said that publicly. So I think that kind of disagreement is there. It's going to grow, and that just means the ability to come out collectively and say anything definitive is just less.
For the record, he is the smarter of the Bostics, but I'm the better looking one. Just for the record, I am curious, Seth, about economic conditions in your view specifically. We know what the Fed is looking for here, but when we talk to market participants and chief economists like yourselves, there seems to be a much bigger, wider divergence, if you will, about whether we're headed for a recession, the timing of that recession, whether we have averted altogether and end up in that cushy sort of soft landing here. Are you still anticipating in the near term recessionary conditions?
So we are not, and let me just go back. I mean, since we started this hiking cycle with the Fed, Morgan Stanley House view, my view, Ellen Zentner, our chief U.S. economist view, we have been saying all along that a recession is not the baseline view. The Fed had, from the beginning, had a strategy to let it take years to get inflation back to target, so it was not a Paul Volcker, let's get it down next year no matter what it takes. We think the labor market still has a long way to go to get back to equilibrium compared to what the level of GDP is, and so that's giving support to the economy. So we do not expect a recession in the near term. We don't have a recession in our forecast going out to the end of next year. Boy, that was not always a very popular opinion. You go back 6 months, 9 months, we had lots of people looking at us kind of sideways when they said, you don't think there's going to be a recession? When has a central bank raised interest rates this much without there being a recession? And we said, well, wait and see, and here we are.
What gave you the confidence to say that you didn't anticipate one?
So it was a combination of the Fed strategy, right? If the main thing that was going to be slowing down the economy and as a result potentially causing the recession was going to be monetary policy tightening, then at least it gives them a fighting chance to avoid it if they want to. Necessary, but not at all sufficient. And then it really is the labor market. We saw in COVID, the economy dropped, employment dropped. Coming out of COVID, the economy bounced back a lot, but employment didn't bounce back anywhere nearly as much. We are still at a point where the economy is backfilling jobs that probably should have been hired a year ago. And it's that continued backfilling of jobs that's sort of supporting those job market data each month, and it's allowing the economy to have that kind of extra cushion to keep us from going into recession.
Well, let's quickly talk about the wild card here, which is China. Of course, we've gotten a lot of disappointing data out of China. If that slowdown that we're seeing on that side of the world is more significant than maybe expected, does that drag the U.S. lower as well?
So I think directionally it's got to be in that direction. China is a big economy, but we also have to remember that the U.S. exports much less to China than we import from China. And so the spillover from China to the U.S., it's got to be there, but I don't think it's going to be material. And more importantly, we are looking for a slowdown in the economy. The Fed is trying to slow the economy down, so it's going in the direction that they want. I think the real question now is the calibration of that tightness. Can they stop raising rates now and just hold rates high long enough to keep things going down? I think they can. And so it goes in the direction of slowing things down, but I don't think it tips us over into recession.
Seth, great to have you here on set. Great insights out of Seth Carpenter, Morgan Stanley's chief global economist. As we kick you off to the close, coming up, a conversation with the CEO of Cava, the fast casual chain, forecasting higher profits for the year following its first earnings report since becoming a public company.
Plus, more data on the health of the consumer as retailer TJX beats on sales and boosts its full-year outlook. Shares hitting an all-time high.
And a deeper dive into the drama over at Goldman Sachs. More great reporting here on CEO David Solomon and the growing pressure from dissatisfied managers to some of the moves that he's made. All that and more coming up in just a bit. Stick with us. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it is then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern. We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing. Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Well, markets are on the move on the back of that latest Fed meeting minutes release. Abigail Doolittle standing by with more.
Yeah, and Katie, it's actually getting more interesting by the second here. This is the intraday chart of the NASDAQ 100 futures, and you can see overnight during the Asian session, not a lot happening, and then some downside here in the U.S. session, and there wasn't really a clear impetus for it, maybe just the risk-on mood, the seasonality we've seen. But since the Fed minutes have come out, we had initially sort of a stabilization, but now we're taking a move lower. We we'd not gone below the day's lows, which I think was down about 0.7%, but it feels like maybe we could in fact breach that level. So investors may be paying attention to my ear, what sounded like a little bit more of a hawkish message in terms of inflation risks could require further tightening, and some of the Fed officials seeing significant risks to inflation still to the upside. If we check in with yields and take a look at the 10-year yield, we are going to see, well, we are at session highs essentially at 4.25. So that would be consistent with the idea, the hawkish view that the stocks are showing to some degree. But what's really interesting to me, and we took a look at this chart earlier, this is the probability that markets see of the Fed cutting rates next year. And earlier this year, for quite some time, they were basically looking for a cut of about 1.5%. Right now, it's closer to 1%. But since the Fed minutes have come out, it's actually widened slightly, which just doesn't make sense to me, again, with the Fed officials saying that inflation risk could require further tightening, not cutting, but here we have, again, Romaine, another divergence between markets and the Fed.
Abigail Doolittle there, a nice look at the housing at the broader market, I should say. A look right now at the housing market on the back of learning that 30-year mortgage rates now averaging well above 7%. You pick your metric and you're going to find it. New housing data released today, though, shows that the housing market right now a tale of two cities. Joining us right now to talk a little bit more about this, let's get right to our next guest, Carly Tripp, Global Chief Investment Officer and Head of Investments for Nuveen Real Estate. Carly, we got some data this morning on housing starts that I guess is pretty encouraging here. We're talking about a jump in new construction that I think exceeded a lot of expectations, 3.9%, a 1.5 million rate of build, applications to build also higher here, and of course permits to build single-family homes also higher as well. Of course, this is against the backdrop of mortgage rates at the highest levels that we've seen basically in a generation here. Square that circle for us as to why we're seeing so much strength when it comes to new build.
Yeah, I'm happy to, and thanks for having me today. I think you hit the nail on the head when you mentioned single-family starts. So we've seen that trending up, and of course, we can't really rely on month-to-month data to inform what's happening, but I think what's really, really interesting is that when we look at single-family starts, they are rebounding and recovering. So why is that when rates are currently over 7%? Well, home builders are offering rate buy-downs. They're building more homes at lower cost, and they're really competitive with new entrance markets, which is competitive with renters. So renters who are delaying the decision or trying to choose between renting and owning are being lured by home builders today at lower prices with incentives that have really doubled from an average of 3% to 6%.
There's obviously some practical and structural issues as to why we're seeing that, Carly. I wanted you to sort of address this from the perspective of an investor, given how much Nuveen Real Estate actually manages, $150 billion plus. Give us a sense here as to whether you find anything of value to invest in the residential space.
Absolutely. For rent housing is one of our high conviction calls. We don't, of course, invest as a home builder, but what you see on the home building side, again, is new homes represent now 1 out of every 3 sales. That's compared to it typically being 10% of the overall market. What that tells me is that end of affordability is really strengthening. When you have a consumer who is now facing a mortgage cost monthly of double what it was 2 years ago, it's just become unaffordable. So when you look at average incomes, the average earner in the U.S. cannot afford a median home. And so that is igniting and sparking the demand for more affordable entry-level houses. It's also sparking demand for rental. We expect that to continue. And just from a macro, high-level thematic perspective, of course, there is still a structural undersupply of housing across the U.S. That's coming out of a decade of underbuilding post-GFC. So the rental day-to-day is still relatively strong, albeit is moderating. So I would expect that data to come through the inflationary numbers and really ease inflation going forward. We have seen it half in the last 60 days.
Well, Carly, you talk about how that undersupply is a structural issue. It really comes out of that post-financial crisis period. But when you think about what we're seeing right now, to bring it to right now, we talk about mortgage rates so high at this moment. How much of the the supply crunch that we're seeing comes back to the fact that probably if you got a mortgage rate back when rates were at 3%, you probably don't want to move right now.
You don't want to move. 80% of Americans have a rate of less than 5%. 60% of Americans have a rate less than 4%. So again, the resale market is going to be in complete gridlock until we can get to like a long-term norm mortgage rate, which we believe is below 6.5%. So if you start inching closer to the 6% cost, we believe that homeowners will become agnostic and start to transact again.
And Carly, not much time left, but again, on the topic of this being a chronic structural issue, coming out of this period when mortgage rates do come down again and maybe supply loosens up, do you think any of those structural problems will get addressed, or is this going to be a long-term issue with us?
It's a long-term issue. It's going to take a while to course correct. You, of course, have folks taking longer to make ownership decisions. Family starts are taking longer. People are getting married later. They're having children later. And all of that buildup is increasing overall household formation. And so the structural issue is really a long-term one. If you look across markets, though, it's not even. So the Sun Belt has really gotten the bulk of the new supply over the last 5 years. If you look at, for instance, new permits to job openings, that is tightest across your coastal markets. And that's also where we're seeing the strongest rent growth today. So the coastal markets have really largely been ignored by builders over the last 5 years, and we would expect those to perform better going forward.
Carly, thank you. Carly Tripp, she is Global Chief Investment Officer and Head of Investments for Nuveen Real Estate. Coming up, the power struggle inside Goldman Sachs, why CEO David Solomon is facing growing pressure from dissatisfied managers. That's next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Another day, another story about some of the discord going on at Goldman Sachs, a power struggle shaping up inside the top ranks of the bank. Bloomberg reporting that managers are frustrated with the leadership of CEO David Solomon and are looking, well, to his most loyal deputy, John Waldron, for support. Sri Natarajan joining us right now, who helped to write this story. And Sri, there's been a lot of focus on John Waldron. I think what's so great about this story that you wrote today is it kind of gets at the idea of just how sensitive this is for him. He's kind of been joined at the hip with David Solomon for the better part of his career, and now people are basically looking to him and saying that, well, are you going to replace him?
In fact, I would tweak that a little bit. I'll say there's been a lot of focus on David Solomon. You have been reading about his leadership style, you've been reading about the issues at Goldman, you've been reading about the dissatisfaction inside the firm. But there is a reason to turn the lens on John Waldron, because at some point, whether that's next month, next year, or 5 years from now, the question is, who after David Solomon? Unless, of course, he wants to pull a Jamie Dimon and stay on forever and is able to do so, there is a real question of who after David Solomon. 2 years ago, the obvious answer was, of course, the sole president, John Waldron, who has been with David Solomon for the better part of 30 years, for over 20 years at Goldman Sachs, and before that at Bear Stearns. It isn't that obvious anymore, and that is why a lot of these executives who already have been loud about their frustrations are pressing him to pick a side.
But what are their frustrations? Are there frustrations with David Solomon, the man, or with the decisions that he's making? Because if it's with the decisions, then I would assume John Waldron at least was a party to some of those decisions, given his rank.
And that's the thing that we keep hearing again and again. There's, of course, David Solomon, the man. There is no denying that. His management style, his leadership has been the focus of a lot of the scrutiny. But there is also some of the unpopular changes he's made. There was that massive push into consumer banking, and then the dismantling of it right when markets turned, that took a bite out of profits, that took a big chunk out of pay. So you're right. As COO, which is the other title that John Waldron has, there is the Goldman president, John Waldron, who's wining and dining the clients, but there is also the COO who's supposed to execute the vision of David Solomon. So some of the things that you blame the CEO for, some of the responsibility also rests on Mr. Waldron.
Sure, we only have about a minute left with you, but this piece is fantastically reported, and you point out that Waldron himself has kind of fanned the rumor mill a little bit here. You point to remarks in July where he observed that whoever's running the shop in 2 years will probably sit upon a cleaner firm. What does that mean?
I would say not fan the rumor mill, but certainly set off the rumor mill, right? People are parsing every remark he makes. I think somewhere in the story we say they're parsing his every eye roll, his every shrug, his every smirk, trying to see if there is some distance with the boss. And when he makes a remark that in 2 years whoever's running the firm will run a cleaner firm, people will ascribe various meanings to it, and that they did. Even if Goldman now says those remarks were misconstrued, that's not how the senior bankers at the firm took it.
Just real quickly, Sri, only got about 30 seconds, but the one anecdote I thought in this story was the idea of David Solomon dropping his middle initial on official documents, DMS to DS, John Waldron keep his. What is that about?
Well, we've never seen something like that, that a CEO staff sends out a memo to other people at the firm saying, I don't want my middle initial to appear anywhere. I'm not David M. Solomon anymore. I am David Solomon.
All right.
All right. A lot going on there. Sri M. Natarajan, who broke this story for us, a great read on the Bloomberg terminal as we keep an eye on the broader markets on the back foot once again here on this Wednesday afternoon. Romaine Bostic and Katie Greifeld. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Markets to Close, almost 2:30 here in New York. Keeping an eye on the broader market and commodities. A big downdraft that we're seeing in crude oil today. Abigail Doolittle standing by with our commodities close.
Yeah, it's sort of been a stealth sell-off here, Romaine, for crude oil. We all of a sudden, I've gotten used to seeing oil back above $80 a barrel WTI crude, and here we are back below 80 at 79.37, down about 2%. What makes it interesting is the fact that inventories this morning, they were reported, they're at the lowest level since January, so that would seem to be supportive of price, but not so much today. Maybe traders still worried about the weakness that we're hearing about out of China, the world's largest user of natural resources. Gold, I put on here just to see if there was a reaction to the Fed. No reaction, down to 0.3%, which was basically the case ahead of the Fed minutes coming out. Wheat, on the other hand, we're seeing a little bit of a bid, and this after there was a Russian attack on a Ukrainian port on the Danube. So up 0.2%. Wheat has been down so much recently, so a bit of a change. And then finally, corn, it is up 1.3%. I'm not exactly sure what's behind that, but it is the best day in about 3 weeks for corn.
All right, nice wrap up there. What's going on in the commodities space? Let's turn to the restaurant space and talk about Cava. Coming off the highs, the share is slightly higher here on the day. This on the back of the fast casual Mediterranean chain. Strong first set of earnings since that IPO a couple of months ago. Of course, the stock has almost doubled since then here. And what I think investors saw in that report seemed to give them a lot of encouragement. Let's talk to the co-founder and CEO of Cava, Brent Schulman, who joins us right now here on Bloomberg Markets to Close. Interesting earnings report here, and the numbers I'm sure matter to investors, but what I think mattered more to them, Brett, was this idea here of expansion, the idea of growth. Where's that growth going to come from?
Yeah, well, thanks for having me. We opened 16 net new restaurants in the quarter in 2 new states, so now we operate in 24 states across the country. So we've got plenty of growth in those existing markets, as well as the 24 plus states that we don't currently operate in. And we talked about entering the market of Chicago next year, our first foray into the upper Midwest.
Yeah, great.
So
city.
really excited to bring the Mediterranean to those communities.
Yeah, I'm not just saying that because I'm from there, but Chicago would certainly welcome you. I am curious, Brett, I know you have had to heard of these comparisons. Everybody says Cava is the next Chipotle, and that's meant, of course, as a compliment here. But when you look at who your competitors are, the types of customers that you want that maybe are shared with other restaurant chains, who do you see as your primary competition?
Well, we want to be the next Cava, and that is the category-defining brand of what we believe to be the next big cultural cuisine category, which is Mediterranean. And the great thing about our Mediterranean cuisine is it has an incredibly broad appeal, right? Whether you're a vegetarian eater, you want to eliminate lactose or gluten from your diet, or you just want spicy lamb meatballs and crazy fat, our food can appeal to a wide variety of consumers. And as our country gets more diverse, we're seeing the trends of consumers seeking bolder, more interesting flavors as well as the trends of modern health and wellness, that people want to eat better, they're more informed about what they are eating, but they don't want to have to make sacrifices doing it. And that's where we come in with our unique cuisine where taste and health unite. And that's evidenced by our proven portability in over 24 states today.
And Brett, as you go ahead with these expansion plans, how worried are you about the macro backdrop, especially when you think about the labor market, how tight it is? How difficult is it to find workers and open new restaurants right now?
Yeah, we talked about our cautious outlook given the macroeconomic headwinds that are building around our guests. As far as the labor market, we've actually seen a deepening and widening of the labor pool. We're fully staffed, higher than 19 levels. You know, every restaurant has full staff complements, but those are above significantly our 2019 staffing levels as our AUVs have grown meaningfully. But when we look at the consumer side of it, we look at the recent spike in gas prices. We look at the cost pressures of inflationary utility bills related to extreme heat we've seen across the country, the student debt loan repayment waiting in the wings in the fall. And we saw in the recent Fed minutes a continued hawkish posture, really looking to temper growth to ensure that they tamp out inflation. We wanted to incorporate those headwinds into our outlook as we communicated yesterday.
Well, you're speaking our language with the Fed minutes drop there, but I want to bring you into a conversation that we were having with the Sweetgreen CEO actually a couple weeks ago about artificial intelligence and what role it might play in restaurants going forward. And I know that you have your expansion plans, probably not thinking about AI at this point, or if you are, what role do you think AI will play for restaurants and specifically for Cava?
Yeah, we look at technology to enhance the human experience, not necessarily to replace it. And so we think about how do we empower our team members to deliver that great Cava hospitality and make that amazing food where taste and health unite. So you can think about utilizing it to be more sophisticated and efficient, whether it's our inventory management and our inventory ordering, whether it's our labor schedule modeling, whether it's prep production and load balancing in the kitchen and cook production. So our team members, it really takes that complex thinking off their hands and does it for them to free them up to really engage with our guests and deliver that great Cava experience.
I am curious, as you expand, Brett, is there a sense here that when you do that expansion, that it's better to sort of cluster some of the new locations in the same market, in certain neighborhoods, or at least a certain geography within that market, or can you sort of spread it around and still make it cost effective?
Yeah, well, we learned that early on, Romain. We went, it was a little counterintuitive, our second market outside our home market of Washington, D.C., we went to Los Angeles. And what we learned, it was like starting a new business all over again. And so as we entered new markets, we've learned over time, we really like to enter with 3 to 5 restaurants over a 12-month period to not only create consumer awareness, but really have that supply chain critical economies of scale, as well as operational integrity and economies of scale from an operations standpoint. So when we go and enter these markets, we want to do a cluster of restaurants. Now, where we locate those restaurants, I think we have a lot of optionality because we compete both urban and suburban. We see success across a wide variety of trade areas. So it allows us to enter these markets in unique ways across a variety of neighborhoods.
And just to be clear, so all of the Zoe's stores, restaurants that you acquired, have they all been converted to the Cava brand?
So we no longer operate any Zoe's Kitchen restaurants.
Okay.
We have converted all but one. One remains open. It'll open in the next few weeks as a Cava.
Okay.
All right, Brett, got to leave it there. Really appreciate your time today. That is Brett Schulman. He is the CEO of Cava. Thank you. Still ahead on the close, cash-strapped consumers are leaving room in their budgets for TJX. We'll talk with Adrian Yee of Barclays about the second quarter results for the parent company of Marshalls and Home Goods. That's next. This is Bloomberg.
names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports. On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
City, from London, in Sydney, from Washington, in Tokyo. 9 a.m.
in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside? Well, we do have some breaking news. This from an interview with Argentinian presidential candidate Javier Milei. Just running through some of the headlines here. He says that dollarization plan among the first measures to Congress, and that if elected as Argentina's president, he would shut the central bank. Again, this in an interview. We're going to bring you more of this interview as it happens, but just running through some of the headlines here. Again, he would shut the central bank if elected as Argentina's president, would seek exit and refuse to work from China. And again, the dollarization plan would be among the first measures to Congress, and that he would make every effort to avoid default. Romain.
All right, a bold call there by the presidential candidate over there in Argentina. Meanwhile, back here in the U.S., let's get to our top calls of the day here. And we're going to start off with Chevron, upgraded to buy from neutral. This over at Mizuho, making adjustments to its stance on U.S. oil stocks. Despite higher prices, the analysts saying there are some secular tailwinds for the sector that allow for more confidence in longer-term cash generation. Chevron up fractionally on the day. Next, Keurig Dr. Pepper getting raised to buy from neutral over at UBS, thanks in large part to high expectations from coffee. The analyst says is pretty confident there that the earnings inflection is beginning, and that's largely due to improved margins from the company's coffee segment in the U.S. Shares up about 1%. And finally, let's take a look at, well, TJX, the retail company behind TJ Maxx, Marshalls, Home Goods, all your favorites. Barclays reiterating an overweight rating on the company after the second quarter report that dropped earlier today. Adrian Yee hailing the off-price model as an accelerant of strength, especially given TJX's exposure to higher income shoppers when compared to rivals like Ross and Burlington. Shares of TJX up 4%, 89.49. That's going to be a record high should it close at that level. Those are our top calls, and we're going to stick with that last call on TJX because it is a big mover on the day. Adrian Yee is joining us right now. She is the U.S. Retail Senior Analyst over at Barclays. And let's just start off here with the secret sauce to TJ Maxx. It seems like when the economy is doing well, the stock does well. When the economy is doing bad, the stock also does well. What's going on?
consumers love value, right? You like stretching your dollar, and you like paying less for something that you believe, the quality is worth more. So that's the secret sauce here. The other piece of it is that off-price is the model itself. It allows these retailers to actually know what people want. So whereas most retailers are buying and guessing 6 to 9 months out, they're placing bets sort of 3 months out, and then they're filling in the next 3 months with known winners. So it's a tremendously strong model when the supply chain is actually allowing them to have that strength.
There's been a lot of discussion, particularly about kind of the lack of an online presence, or at least not to the extent that you see from other retailers. That's that whole omni-channel experience that other retailers like to boast as well here. This is kind of one of those places, whether you're going to Home Goods or TJX or Marshalls or whatever, where you kind of have to show up, look around, rummage around. That's not for me. My wife goes to this place, I feel like every other day, and she comes home with something. She loves it. Here, is there any sense that they would ever, I guess, tweak that model for modern times?
So with off-price, now remember, so they have about 2% of their sales, very, very, very small, right, compared to 30, 40, 50% of the traditional kind of brick and mortar omni retailer sales. The reason that the off-pricers do not do this is because it's kind of cost prohibitive. It's not very profitable. For the typical retailer, while they get hit on the product margin, right, because they have extra shipping, it's really accretive to their overall EBIT margin. That's not the case with off-price. So number one, you want that footfall. You want your wife going in for the treasure hunt, so to speak. They buy things very broad and very shallow. So there's no depth behind it. If it's stocked out online, there might have been a few of them, per store. So those are a couple of the reasons why it doesn't make sense. And you want people in those stores seeing things that they didn't come in for, right? That impulse buying, and then leaving with handfuls, right, of product.
Well, Adrian, speaking of leaving with handfuls, it feels like last earnings season we heard a lot about shrink. We heard a lot about theft. Hearing a little bit less of it this earnings season. Maybe that's my own bias. What do you make of that?
I love the characterization of that. So what's happening is shrink is not good. It's not a good guy. It's not a bad guy. So with retailers, what they do typically, they do a physical count of inventory either twice a year or once a year. TJ does it once a year at the end of the year. That's how they found out they had so much shrink and loss and theft last year. So what's happening now is you're not going to find out whether you're right or wrong. You're clearly monitoring things better. You're tethering your leather goods, right? And you're kind of locking up some of the jewelry and the perfumes, et cetera. But you won't really know until the end of the year. What I will say is generally shrink across the kind of the retail universe, whoever had it, it's not getting better. But it's certainly not getting worse, and they are monitoring it, and they've hired kind of store payroll hours to watch the sectors that are kind of more susceptible to that shrink and theft.
Well, it will be fascinating to see those year-end numbers. Unfortunately, we have to leave it there. Adrian, hope to have you back soon. That is Adrian Yee over at Barclays. From New York, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets at the Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. David, a lot of great interviews that are featured on Wall Street Week, and I'm told that you had a chance to sit down with a couple of folks to talk about AI today.
Yeah, back to AI, but from a slightly different direction. We have two people who wrote an article that's out today, actually, in Foreign Affairs, talking about the geopolitics of it. What it's going to have to do to the way we regulate and the way we structure this around the world. It's written by Ian Bremmer. He's a Eurasian Group president, and Mustafa Suleiman, Inflection AI co-founder. He's also the author of The Coming Wave, Technology Power in the 21st Century's Greatest Dilemma. That's coming out just in a week or two. And we talked to them, started talking about how big and how fast is this coming and what do the governments have to do about it.
This is going to be the most important transformation of our lifetimes. I mean, think about it. Everything that has made us productive as a species is our intelligence. You know, everything around us is created because we have the ability to simulate, to plan, to imagine. And now we're teaching machines to do the same thing. We have generative AI, we have many other machine learning tools now, which are getting better and better at producing great value in the world. And I think that is going to be the biggest turbo boost to productivity and invention and creation that we've seen in the history of our species. This next couple decades are exactly the productivity boost that we need.
Ian, we've seen technological waves in the past. I mean, perhaps one of the things we think about is the internet, which changed an awful lot of the way we conduct our lives, also changed the way governments react with one another, corporations do. Is this the same sort of change, or is this of a different kind?
Well, it's similar in the sense that the internet, in the virtual world, the digital world, technology companies are dominant. They're functionally sovereign in deciding how the internet functions, who gets to see what, how you interact, do you have a platform, do you not? But with artificial intelligence, the influence and power that the digital world has over our lives, in how we think, in what we're capable of doing as individuals, as corporations, as governments, in our national security, in our economic productivity, is increasingly being driven by these same technology companies. So it's one thing to say the technology companies have control of something that's kind of marginal. It's another to say that they have control over something that is fundamental to how we think about power in the world. And if you want to regulate it and govern it, as Mustafa and I are saying is utterly essential and yesterday, that means that you're going to have to work together with the technology companies in creating these institutions and architecture. And that is something we've never seen before.
Yeah, and I want to talk about the proposals you and Mustafa have in Foreign Affairs. But Ian, I'm curious about, as we go into this, are the incumbents likely to prevail, at least in the initial phases? And I mean that both in the private sector in terms of the really big tech companies, but also some of the countries that have rather than have not.
I think we don't know. I mean, the fact is that right now there are only a very small number of companies in two countries that are dominant players in AI. My co-author and friend Mustafa, one of them in that White House meeting with Biden just a couple of weeks ago, there were only 7 represented. But this technology is expanding far faster than Moore's Law. It's 10x every generation, as opposed to, in a year, as opposed to 2x every two years. for semiconductor speed, for example, and reduction of price, and the proliferation of the influence of those models, not just in terms of what companies build them, but what individuals and organizations, some for good, some for nefarious purposes, will be able to drive this AI revolution within a matter of a very few years. We're talking not about 10 actors or 100, we're talking about hundreds of thousands.
Mustafa, the challenges for governance are just enormous, as you lay out with Ian in this foreign affairs piece out just today. But it strikes me that any one government has a challenge in trying to catch up with technological change. We've seen that again and again and again. We're looking at something that needs to be, I think, global, given its nature. What are the basic approaches that should be taken, understanding that none of us, I don't think, perhaps not even you, knows actually where it's going to end up?
Look, I think technologies are always very difficult to predict. By their very nature, they have emergent properties. When they interact with the world and they are actually used and they're then adapted, they change form and change shape, and they're doing that very, very quickly. So the challenge is really significant, but I think there are lessons that we can draw from existing processes. So, for example, the Intergovernmental Panel on Climate Change has been incredibly effective at bringing together a very, very diverse group of scientists, civil society groups, academics, and of course governments, to actually establish the scientific fact base for what is happening over a multi-decade period. And I think that we need something kind of similar for artificial intelligence. Think of it as an international panel on AI, and its primary job would be to be an independent, science-based, accurate assessment of the pace of change, the strengths and weaknesses of these models, their constituent inputs, so the data that is used to train them, the chips that are used, that they train on. And that would, I think, help people to get some confidence that there is an independent expert body that is at least tracking progress.
And finally, Ian, there's the multipolar issue that you lay out in your piece. There's also a bipolar issue, which, as I understand it, one of the things you're suggesting is we have to start with the United States and China, right where we are, because they're in many ways the two leaders on it. What are the hopes and dreams that you have for the United States and China to come to anything approaching a framework jointly to address AI?
Well, this is a question that the Bloomberg audience is going to particularly resonate with, because AI is not like an arms race between the United States and the Soviet Union, now the US and China. It's much more like a structural aspect of our global order that must be harnessed and can't be allowed to destroy everything we've built. In that regard, it's much more like the financial markets. And Mustafa and I suggest a techno-prudential approach to regulation, like the macro-prudential approach we have in the marketplace. Think of the Financial Stability Board, the IMF, the Bank of International Settlements. These are all organizations that the Americans, the Europeans, the Japanese, and the Chinese are a part of. And they are, the reason they join is because they all want to identify and mitigate risks to global stability in the financial markets without choking off innovation.
Those are the authors of the AI Power Paradox, out today on Foreign Affairs. Ian Bremmer, Eurasia Group President, and Mustafa Suleyman, Inflection AI co-founder and CEO.
Our thanks there to David Weston here as we head into the final hour of trading here on Bloomberg Markets. The close higher on Treasury yields, lower on U.S. equity prices right now as a market having to digest more concerns about China.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Geez, that Matt Miller, it's like, just walking in our studio, taking over. He was just talking with us, guys, about a story that's coming up a little bit later on.
He's got a lot of thoughts, and maybe we'll have him call in.
I said he really, studied really well when he had this guest on air.
He did, yeah.
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 He was really the journalist.
We got her on the show later.
We're going to talk specifically about the high-potency pot market worth billions that's drawing regulatory scrutiny.
That's the most important story on Matt Miller's mind.
Good afternoon, everybody. It is Wednesday. It's not Elon's world that we're all living in and paying rent. It's Matt Miller's world, and we're all paying rent. This is Bloomberg Business Week, live in our Interactive Broker studio on YouTube and Bloomberg Originals. Carol Masser, along with Tim Stenivek. And it is Wednesday, but where is everybody? Low volume. We had Fed minutes. We've got lots of news out of China. It continues to come out. We're going to cover that. That really is a focus for us.
Yeah, we're going to have several voices on China, including the team over at the China Beige Book. They've created their own private network for tracking the Chinese economy. So do they think China is a, quote, ticking time bomb?
Yeah, listen, this is what President Biden said. So we're going to see what everybody has to say about that. We've also got, really... I feel like a duo of people who have seen the cycles out of China for a long time. So I'm just curious to see what their assessment is. Having said that, we're also going to get into the most read on the Bloomberg about Goldman CEO, most loyal deputy being tested by mutinous partners. Dun, dun, dun. It's like Game of Thrones, the Goldman version.
Yeah, the most read story on the Bloomberg today, as you mentioned, Carol. We're also going to talk retail on the heels of TJX and Target reporting today. We also got Walmart later this week.
I got to say, when I go shopping, TJ Maxx, it's like my go-to. Home goods, too.
I feel like I hear that from you quarterly.
It's kind of, who needs therapy? I've got that. All right, we're going to get into that. We've also got, did you talk about the two Nassau counties?
Not today.
We've got the tale of two Nassau counties.
I didn't even know there was a Nassau County in Florida.
I know.
Did you? Oh,
sorry.
Carol's going to get some water. Long Island and Florida tell two very different stories. Ben Steverman is going to join us a little later today. It's in the upcoming issue of Bloomberg Business Week.
Okay, sorry. That's what happens when you inhale your peanuts just before coming in on air. And then, of course, we've got a lot on the markets because there's a lot going on. It's kind of, as we said, a quiet volume day, but a lot of news that continues to come at investors, Tim.
Yeah, I wonder if it's not quiet in China.
No, I'm sure it's not. And I bet I'm waiting for what the next 24 hours brings. In the meantime, we are going to head over to our TV colleagues, talk about the trade, because we do have equities bouncing around their lows again. And we're watching that yield trade. We've got some economic news and those Fed minutes. But right now, over to Katie and Romaine, because we've got Countdown to the Close starting right now.
Comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. Romaine Bostick alongside Katie Greifeld, joined right now by our colleagues Carol Masser and Tim Stenivek. Welcome to our audiences across all of our Bloomberg platforms on another down day for U.S. equities, another up day when it comes to Treasury yields, Carol Masser, and of course another day where we continue to obsess about what's going on over in China.
Yeah, and that's it, right? We have this obsession because it feels like in every 24-hour news cycle there is a flurry of headlines, just like we saw in the last day or so. And you've got one of China's biggest shadow banks. They're skipping payments on investment products, kind of not with a strategy about kind of what happens next. You've got some another batch of disappointing economic news, and you've got Fitch talking about maybe a possible downgrade. I know they talked to Bloomberg Television earlier. Fitch.
Yeah, they've really been downgrading a lot.
They're on a roll.
Yeah. It's like they all just came back from vacation and decided, hey, the world is burning. Maybe we should do something.
Calendar turned to August. It was time to go.
Well, the big question that we have is to what extent are these problems contained in China, and to what extent, Romaine, do they actually get worse? We're really spending a lot of our program today asking those questions. We got some great guests this afternoon. Dexter Tiff Roberts, he wrote The Myth of Chinese Capitalism. He's going to be joining us. And then Shahad Kazi, who's got the China Beige book. So
interesting to look at some of the price action in whether it's Chinese stocks over there or the ADRs that trade here in the U.S. Because you remember we had that big sell-off earlier this year when the sort of reopening boom that everyone thought didn't sort of materialize. And then everyone decided, okay, well, things got oversold. Let's start to buy back in. And now you have this slew of economic data that shows that maybe there was reason for that sell-off to begin with.
And it's going to be really interesting to see how China responds. Of course, we know they've been responding on the monetary front. Whether we do get fiscal stimulus, of course, it's been reported that they don't want to do that, but we'll see if the data
You know what?
forces
You know
their
what might
hand.
help them, Katie?
What's
if
that?
they just brought everybody back to the office.
You know, what a perfect segue.
Nicely done.
There was a really interesting New York Fed survey out on the topic of work from home. Interesting numbers here. This survey found that 25% of business leaders have changed their policies over the past year to require more in-person work. 17% plan to do that. Overall, these service firms, they would prefer that 3/4 of their workers be back fully on site. But the survey also found that only about 68% of employees actually work in person all the time. But even 68% really surprised me. That seems very high for fully in the office.
Yeah, but then like some of the data that they had in that same survey, particularly when it comes to service firms and the benefits of work from home, I mean, they make it clear that, you know, having that flexibility is huge for employee retention. It's huge for recruiting employees, but none of them actually seem to think that it was good for building a workplace culture.
Well, and if you think about like a country where people have not been moving around for decades, that finally not hybrid, but working from home gives an individual an ability to work in one state and maybe work many states, at a company based many states away. So I don't know. I'm not quite sure how this all ultimately trickles out.
I mean, it's pretty simple. Employees like working from home. Employers don't like when they do that, Katie.
Is Carol wearing polka dots today?
There's the tension.
What is that?
I love it.
Yeah.
I saw her in the pantry. It's a really pretty dress.
Yeah, it's like Kwame.
Anyway, I also in this survey did think it was interesting, moving swiftly along, sort of how bifurcated the labor force could become if hybrid really does pick up, and that is the future, because this survey obviously found that at manufacturing firms, 94% of employees work in person. So, of course, we have these conversations about hybrid workplaces, and that's
94% of people in broadcast work in their
that
office.
too. Manufacturing workers and broadcast people were in the office.
I just want to know, is that the good-looking Bostic, or is that the smart Bostic that's next to you?
Both.
Just remember, it's a digital world. We catch it all. All right, guys, we're going to continue this conversation, count you down to the close on this Wednesday. Our cross-platform, on radio, on TV, on YouTube, and Bloomberg Originals with the good-looking Bostic. It's coming back at 4 p.m. Wall Street time.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, it is a wacky world, and we're all just living in it. Between the economic data points, trying to keep track of all the news out of China, and then, of course, about 67 minutes ago, we got the latest minutes from the last Fed meeting, Tim. And key takeaway, Fed officials at that meeting largely remained concerned that inflation would fail to recede and suggested they may continue raising interest rates.
Are you surprised?
No.
Okay, just wondering.
No. I think this is, unfortunately, the Fed is going to be very careful about not backing off too early, because the crime would be, the economic crime, the environment crime would be that all of a sudden inflation continues to rear its ugly head. At the same time, I would continue to argue that 2%, I think many, is not a realistic rate that we get back down to.
Okay, well, let's put it to the panel, because we got a great group joining us this afternoon. Stuart Paul is U.S. economist for Bloomberg Economics to give us today's market reaction to all this. We also got Bloomberg News Markets reporter Abigail Doolittle. They're both right here in our Bloomberg Interactive Broker studio. Stuart, I want to start with you. And were you surprised at all by the minutes that came out a little over an hour ago?
What's interesting about the minutes is that the Fed maintains an optimistic approach, that it can maintain some sort of a soft landing, but it's not really fully willing to commit to hiking rates further given that optimism, right? So it's maintaining a sort of optimistic outlook about the economy, but it doesn't fully translate into policy space one for one.
Okay.
I would agree from the standpoint that they're talking about more hikes. They're saying that inflation risk, they still are seeing significant inflation risk. Only 2 members at the July meeting called for a pause at that time. What really continues to stand out to me, though, is the disconnect not just between what the Fed's color is in their policy action, but the markets in the Fed. Because if I go into WIRP right now, WIRP next year is calling for 1% in cuts. And and yet here you have the Fed talking about they think they may have to hike more. Fed Chair Jay Powell a couple meetings ago was talking about the idea that cuts are years away. So there's this real disconnect on all levels around Fed policy.
Well, and what I wonder is, how do you guys think about, and let me go back to you, Stuart, is that the idea that, okay, could, as soon as the Fed say it's safe, be pretty aggressive in cutting rates? That to me would say the economy's falling undone.
Yeah, I agree with you. Well, I'll let...
No, go. No. It's a free-for-all.
I could hog it all, so I'm not going to.
No, I think that that's fair. I think that that's a reasonable concern. What we see here in that, let's just think about market
pricing. Is it a concern,
for a
or could the Fed actually do it? Like, be aggressive on the downside?
The Fed could be aggressive on the downside, but it really depends on the extent to which inflation is coming in. If we see a stagflationary environment where we have growth materially slowing when we say we enter a recession in Q4 or Q1 of 2024, but we still have a core inflation running hot, I think the Fed would really be slow to cut rates. I think that it would be backing off any sort of potential rate cuts until the second half of 2024.
She's chomping at the bit. Come on back.
Go for it, yeah.
Yeah, no, I tend to agree. I mean, I was just talking to our colleague, Doug Krisner, about this. He and I talk philosophically about markets pretty much every day. And the only way that I can make sense of this massive call for this big cut next year is if we actually go into some sort of a hard landing, a recession, because why else would they need to cut? Because I think that the greater risk is what you were outlining before, Carol, is basically the 1970s, that they cut too soon and then inflation rears its ugly head and goes back higher. I think that they want to make sure that it is steadily in the right direction down.
How do we think, though, about, and I think, was it on the terminal, or David Weston catching up with Larry Summers? He's a contributor to Wall Street Week, but this whole idea that he sees the 10-year yields averaging 4.75% in the coming decade. That says to me that we're at a higher
as an average
level, as an average. So is it possible, I'm waiting for the Fed to back off of it, but do we possibly, Stuart, get kind of a rethink about where rates ultimately settle and where we think about inflation settling?
Right. So for that to be the case, I think that the Fed would have to probably raise its average inflation target to 3%. I just don't think that we have the real growth necessary to maintain an elevated 10-year like that over the next 10 years, for example. I think that we would need to see persistent inflation. One thing to think about when we're thinking about the growth outlook, especially in the nearer term, and when we think about market pricing, not to totally harp on it, but the market pricing is really just an average of expectations, right? So there are really two camps that are out there. There's the camp that thinks that there's going to be a very serious hard landing and is pricing in material cuts for next year.
Where is that camp?
It's getting
all I know is
getting smaller and smaller.
The camp that we keep talking about is like, what recession? Like, it's gone.
I actually know one sophisticated real estate investor, and he seems to be indicating, he hasn't used the words hard landing, but he certainly did not agree to the idea that there could be a soft landing. So I think that some people working with certain parts of the economy may, in fact, still be there. But yeah, I mean, it's a small camp. But these narratives shift so quickly. So we could be having this conversation in 2 months, and then all of a sudden everybody's looking for the hard landing and where the soft landing can fall.
Can I just say, I tweeted this out earlier. Overheard at Bloomberg Radio, Bloomberg Surveillance. It was Lisa Abramowitz, Jonathan Farrow. They had a guest, and he said, productivity in places is slowing as global warming moves to global boiling. Takeaway, higher for longer reinflation. This just speaks to, I feel like, some of these bigger fundamental changes, whether it's climate change, I know I bring it up a lot, whether it's, shifts in greener energy, aging population. I do wonder if there's some bigger macro factors at play that ultimately will mean that we are going to be in a different environment. It is different this time around.
There could be. I mean, I would point to, in 2 weeks, Jackson Hole, the topic for that meeting is shifts in the global economy. And that's not even the exact title, but it's something, I don't want to say ominous, but it's big. And so if the experts who are running the world central banks think that there is going to be potentially some kind of paradigm shift, that could be potentially systemic, that could cause things to be different this time, although I have a hard time saying that phrase only because they generally tend not to be. And one thing I would point out is we're seeing a bit of a sell-off as we're talking here. The S&P 500 now down near session lows at 0.6%. The NASDAQ at session lows down 0.9%. And the interesting thing is, yields are picking up just a little bit. You have that 10-year yield up 5 basis points now. The dollar also at session highs up 0.2%. So it seems as though markets are listening to our hawkish conversation.
Structural shifts in the global
economy. We move markets here.
You got it.
Hey, Stuart, come on back in here and give us an idea of this idea of last mile and getting down from 3% to 2% inflation and just how long that's going to take. What are you forecasting at Bloomberg Economics?
So we're expecting to not get back to 2%, say, core inflation, core PC inflation, until we're getting into 2025. And a big part of that is because if the Fed were to back off too quickly, it would reinvigorate real estate a little bit. We're already seeing an uptick in home prices, and that's going to end up contributing to core services inflation. Core services ex housing is still primarily a factor that is tied to the labor market, which remains relatively tight. We think that there are cracks under the surface that indicate that the labor market is looser than, say, the 200,000 jobs or so that have been averaging over the last several months.
What are those cracks you're seeing?
This is going to be interesting, and you're going to remember this conversation next Wednesday when we get the benchmark revision from the Bureau of Labor Statistics. So just to nerd out a little bit, so every quarter, the Bureau of Labor Statistics does a census of 11 million different places of employment as compared to the several hundred thousand that are done every month. And that several hundred thousand is used to generate the non-farm payrolls, but the broader census is used to create a benchmark against which those surveys are then conducted. So next Wednesday, we're going to end up seeing a benchmark revision, and if you look at the growth rates between the census data that was released covering everything through 2022, and we compare that to the non-farm payrolls aggregated through to 2022, there's about a 1 million worker disparity there. So if we were to see that benchmark revision come out next week showing 1 million fewer people employed on payrolls than the numbers are currently indicating, that's the sort of thing that the Fed's going to have to take into consideration when it thinks about the direction of, say, core services inflation ex housing, right? Just how much wage inflation can generate services inflation.
So increasingly then, bring it back to the markets, Abigail, are we increasingly seeing investors question the valuations that are out there today?
That's a great question. It's so funny, actually, as I think everybody's a little bit stunned by the sell-off that we have in August, which...
It always happens.
Exactly. It's seasonal. This is when we
everybody,
see,
right?
Yeah. I think, though, the fact that it's the worst, month of the year right now, the NASDAQ 100 down, at this point, it must be down 6% on the month. The S&P 500 down closer to 4%. I think folks are a little bit stunned. But around valuation, one reason they might not be talking about it, and this is kind of stealth in my mind. I mean, NVIDIA, from the recent peak ahead of the upgrades from Morgan Stanley or the positive talk from Morgan Stanley, it had been down 15%. Tesla is down 25% from its peak. Meta is down 10%. So we have seen some of the froth come out of these big tech names. The question is, how much more? How much more do we go? And technically, there's good reason to think I should pull up the chart of Apple because that's always going to be the benchmark on this. Once Apple gets to the 200-day moving average, because it actually, I think, is probably through the 100. Yeah, so once Apple... we could be going down another, just quickly doing this on the fly, another, 5 to 10% potentially. So this pullback might actually turn into a little bit more of a correction, but it's healthy consolidation.
Tesla's still up 84% this year. NVIDIA's up 198% this year. The NASDAQ 100's up 36%.
That for the optimists, Carol
Bassett. No, yes. I'm just saying.
No, but it's true.
Right?
And that's how frothy things... It was the best first half ever for the NASDAQ. So some of that's coming out. It's healthy.
Sometimes you take a rest. All right. Abigail Doolittle covers the market. Stuart Paul, who covers the economy.